We are ready. Okay, good morning, ladies and gentlemen. I'll do a sound check with my co-host and a check that you can see the PowerPoint. John, can you see the PowerPoint and hear my voice?
I can see it and I can hear you.
Okay, great. All right, ladies and gentlemen, this is the second session for St. Killian's Church. So I welcome you this morning. Thank you for joining us. My name is Jerry Muir, and I'll be the individual taking you through this PowerPoint. We've got some other folks on the line, and they may chime in from time to time. All right, so as far as our objectives this morning, we will conduct some introductions if we do have some folks on the line here from our leadership team. We'll talk about what are called selected IRS forms and pubs. We went through a number of them last week, and so we'll talk about certain ones that you will most likely see during the season this coming January when we start. And then we're going to introduce you to a very, very basic tax return called the Billy Franco return. We'll walk through it in the TaxSlayer Pro, or what you might know as the Practice Lab. And then we're going to talk about selected income and adjustment topics today. And then we're going to walk through the Schedule A, which is itemized deductions, the Schedule C, which is self-employment, and the Schedule D that's used for capital gains and losses and capital gains distributions. And then we'll jump into a tax return exercise where we combine those topics of the Schedule A, C, and D and other matters. So essentially a comprehensive return. And so our session will go all the way to 1 o'clock, no later than 1 o'clock. And then what we'll do is we'll break on the hour so you can get recharged as needed. Okay, I want to run through this. I know we have a number of new folks in the classroom or the Zoom session this morning, so kind of give you a frame of reference. I think that's really important. Our IRS contact is Christine Gallardo, and what she does is she's the individual that administers this program on behalf of the IRS. She's an employee in what is called wage and investment. That's an operation or operating division. And then she's in a department, if you will, called Stakeholder Partnership, Education, and Communication. So you may hear her name. You may see her at the site from time to time, and she is our IRS contact. And then we're under the umbrella of the Orange County United Way. They have a number of sites in Orange County. They do a lot of things in addition to VITA. Our two primary contacts are a new employee there by the name of Raven Gates, and I've had an opportunity to chat with her via email. And then we also have Omid, and Omid's been around for a number of years. He's got that institutional knowledge. And if I remember correctly, Omid is a CTEC registered tax preparer, which means he's got a certain training level for taxes. And he's been around for a long time, so he's our point man for a lot of different things. And so you may see him at the site, you may see his name on emails. And then I think it's important to go through the St. Killian's VITA team. In the front office, Susan Armstrong, she's been there for a number of years. She's the business manager, and she's the individual who handles the grant. The IRS gives us, meaning the church, a grant. I think we've had it for the last few years, and those grant monies are used obviously to support and to run the VITA program. Things like paper, computers, printers, and certain personnel receive a modest stipend. And then Fred, I'm going to call and see if he's with us this morning. Fred, if you're on the line, can you jump in and say hello to the world? And if not, I'll introduce you in absentia. All right, I guess he's not with us. So Fred, he is
hello, Jerry. Jerry, sorry.
Oh, Fred's here. Fred, can you say hello to the world?
Of course, I welcome everybody else to the third VITA Zoom training, and it's been a great training ground for all of us, particularly those who just joined us this year from the recruiting event we have from St. Killian. I believe we have so many that I don't have all the name yet, but certainly we will be calling them or talking to them to ensure that they have all the proper training as we are going through the process. Anyway, welcome aboard and welcome to everybody else, and happy Veterans Day to our veterans, which I am one, and Jerry Muir, and certainly more among others. Have a good morning and welcome aboard.
Okay, thanks. And then Fred is also the individual who has gone out from time to time and purchased lunch for volunteers. So he's definitely a key player. And then my name is Jerry Muir, and for those of you who have not met me, I used to work for the IRS. I'm an enrolled agent, and I'll be the site coordinator this year, and I'll be the one of the trainers. We have a number of folks who are involved in training. And then another individual that you'll see at the site, and you'll hear, her name is Emily Itak. I've worked with her for a few years. She's also a CTEC registered tax preparer. CTEC is an acronym that stands for the California Tax Education Council. And in California, if you're not an attorney, or if you're not an enrolled agent, or if you're not a certified public accountant, and you want to do taxes for pay, then you have to belong to CTEC. It's a great organization. They got a lot of training themselves. But again, Emily's going to be with us this year as the assistant site coordinator. And then we've got Mel. You probably have heard his name in the past. He'll be working with us. And Art, he's been around for a while. He'll be working with us. Steve is not with us today. He's our IT guy. He's got a small team, and they're very good. He's also right now going to be the electronic return originator, and that's the individual who will actually e-file returns. The vast majority of our returns are going to be electronically filed. In some cases, we'll make that attempt. The return will be rejected. We'll try to perfect that return. And then after a couple of attempts, then we'll say uncle, and we'll inform the taxpayer to print out the return or make a copy, or we'll give them a copy, and then they'll simply mail it into the IRS. But again, the vast majority of returns are electronically filed. And then we've got John. He's an enrolled agent, and he also works in the tax world. He's our training coordinator, and he's on the line. John, any words of wisdom?
No, and I'll just be managing the chat. So hopefully everyone
Okay.
can download the PowerPoints that are there, and also click on the link to the YouTube channel. And Scott just posted a link to the St. Killian VITA site. So.
All right, very good, thank you.
Okay.
And then we've got Evelyn and Adela, and what they're going to do is they're going to send out the intake and interview form along with the cover letter. And most of us know what the 13614C is. Of course, it comes in different languages. Primarily, we use English and Spanish at the church, but it comes in Vietnamese, it comes in Mandarin Chinese, different types of languages. But that intake and interview sheet, accountants call it a lead sheet, and it's required to be used at our site. And what it does, it gives the taxpayer an opportunity to complete it, and then along with that form and what we call information returns, then of course the tax return can be filed. So that will help out, that 13614C, along with the cover letter going out to our customers. Okay, then I wanted to go through, not all, because if you ever ask anybody how many different types of publications, documents, and forms that are on the IRS website, it's not 20 or 30, it's thousands, literally thousands. And I mentioned last week, I'm a professional tax preparer. Every season I bump into a new form I've never seen before. And so sometimes you're going to bump into a form you've never seen before, but the ones that are shown on the screen here are the ones most likely you're going to see on a regular basis, or you're going to be working with sometime, either in the training portion or in the actual tax preparation season. And so our big one, which we're going to talk a little bit this morning, we're going to go through selected portions of the 4012. That is out for the new season, so for tax year 2022. And that's called the Volunteer Resource Guide. It is a voluminous document. It's prepared by IRS employees, reviewed by, in some cases, IRS attorneys, and then it's used by the volunteers. It does a great job. Of course, like any publication, nothing's perfect, but it does a pretty good job explaining how to make entries into the software that we use and explaining some of the tax law. And the tax year 2022, it has been published. It's on the street. Right now, you can find it electronically. And so if you go to the IRS website and you type in publication 4012, tax year 2022 will pop up. Now, as far as the hard copy 4012, what happens is our IRS representative, Christine Gallardo, she'll order some, and the expectation is every volunteer will have a hard copy. And then at our VITA site, we'll have hard copies. So you can refer to it. So for example, last
Jerry,
season.
just one comment. This is for St. Killian volunteers that Christine will have, at least for St. Killian. If you're at a different site, then another person will manage it.
Yes, if you're at a different site, if your representative is Christine, because there's different representatives in Orange County depending on your program, but most likely Christine will be your rep, and if you've gone through proper channels, and she'll order the 4012 for you. Okay. All right, and then the 4012, I'll give you an example. Last season, I was at the church parking lot along with a bunch of other volunteers, and every once in a while we'd have a question: is something out of scope? Which means, is it something that we can't work in the program with? We'd go to the publication 4012 where there's an in scope and out of scope section, and we'd refer to that. So that's very, very helpful. And then again, it just talks about income, it talks about credits, it talks about deductions, does a pretty good job. And that is one publication. There are many publications. We'll talk about the ones that I think are pretty important that'll help you out. The 6744, I did see some email chatter in the last week regarding that. That also is something that's very useful. I mentioned last week, and I'll mention again, when I certify as a volunteer, like we all have to certify, what I do is I get the 6744 in a hard copy format. I will go ahead and read the questions. I'll answer the questions. I'll look them up in the 4012. And then when I'm ready to certify electronically in the Link and Learn program, I'll sit down, I'll open up the Link and Learn program, and I'll open up the certification, what we call the certification or the test, and I'll plug in my answers, and then I'll submit. That's one way to do it. There's many ways to do it, but I like to do it that way. And I recommend that particular format. And if you're brand new to the program, these certifications, they are untimed and open book. And so that's pretty good. So there's really no reason why you shouldn't be able to pass, at least on the second opportunity that you get. So just take your time when you're ready to certify. And if you don't know an answer, you can look it up in the various publications that we're going to talk about, to include the 4012. Another publication that comes out, this is revised every year because the tax law changes every year. And in 2022, now we're talking tax year 2022, there are significant changes to the earned income tax credit. There are significant changes to the child independent care expense, child independent care expense credit. So you'll see those changes not only in the 4012, but also related IRS publications. And so what you're going to do, if you've been in the program for a number of years, you may think this is the way it is. Well, you got to realize the tax law changes every single year, and sometimes significantly. So the publication 17, which I understand will be available electronically, which that's okay. I'm an old guy, and I know a lot of older or senior citizens like to have hard copy documents. What you can do is you can find a computer or find a loaner computer. You can download these documents, and then you can bring them up on your computer and you can look up answers. And if you want to print selected pages of documents, sure, then you can do that. But the publication 17, this is going to be most likely on the street, which means it'll be published probably sometime in January. And again, it gives you all the updates. It talks about, in plain language, income, expenses, and deductions. And then this is important about the publication 17. Because the body of tax law is, I'll use the word huge, publication 17 will then direct you to other publications when you want to look up an answer. And so the short answer is, if you have a tax question, and keep in mind our program is basic tax preparation. There's many different types of returns we do not prepare, and there are many topics on a Form 1040 that we don't address in our program because we simply don't have the time to do it. The tax world is huge. So anyway, the publication 17 will direct you to other publications to look up an answer. And that's also a go-to document, which we will have either in electronic. Sometimes we can get hard copies. but electronic copy 17, pub 17 is sufficient. And then the publication, excuse me, the form that we'll be working with, and you will see it'll be generated every time a return is prepared, is at 1040. And for our seniors, our taxpayers who are 65 or older, what will happen automatically, because we'll put the date of birth of the taxpayer into the system, the Form 1040 SR will be generated. So the only difference between the 1040 and the 1040 SR is going to be the font size and the number of pages, but it's the same data. And so if you do see the 1040 SR printout, and what that means is the person in front of you is a senior, 65 or older, and they're going to get the SR as opposed to the 1040. And then other schedules that you're going to see in the program, we have the Schedule 1, Schedule 2, and Schedule 3. And if you remember going back, about 4 years ago, we had a Form 1040 that was very long. And some folks in Washington decided to go ahead and make the Form 1040 a shorter document. I think it was most likely probably a political thing. And what happened when you made it a short document, the 1040, the IRS says, well, we still have to have all these lines. And so they created Schedule 1, 2, and 3. So you can make an argument either way that it's short or it's not short. But the bottom line is these are the schedules that we now have. And so data will be populated on these schedules when you print out or look at a tax return. So the Schedule 1, it talks about additional income and then adjustments to income. And we're going to talk about that today. Part 1 or page 1 of the Schedule 1 has additional income. For example, unemployment compensation is one of those additional income items that you'll see on page 1, Schedule 1. And then adjustments to income, that'll be on Part 2 or page 2. And when you hear the term adjustments to income, what that means is there are certain items that will reduce income to create what is called adjusted gross income. So an example of an adjustment to income will be what we call the educator expense. So if you're an educator, which means you're teaching kindergarten through 12th grade and you're expending your personal funds on behalf of the students, then you most likely will be entitled to an educator expense, which is an adjustment to income. And other things, if you're self-employed, there's a thing called 1/2 self-employment tax deduction. That's another adjustment to income. And this is a good thing, especially if you're new to the VITA program. These things will populate on these schedules automatically based on your entries into the software. And then Schedule 2, additional taxes. And like I always tell people, we're used to what is called the individual income tax, but there are different types. I stand corrected. Additional income. Additional income is Schedule 2. Also additional taxes. There we go. And so one thing you're going to see on the Schedule 2 is the self-employment tax, which means if you are a Schedule C individual and you have net income of $400 or more, you're going to pay what is called self-employment tax, which is separate and distinct from individual income tax. And then something we're going to see in the program from time to time, we'll have individuals who are receiving tips and they don't report their tips to their employer. This is something that happens all the time. And so what happens is when we talk to those individuals, they have to report the tip income. They also have to complete what is called an IRS Form 4137 to report Social Security tax on tips. So that's an additional tax. And then we see another thing when you're talking about a distribution from like a 401k, which is a tax deferred savings program. In a lot of cases, especially you're talking someone who's under 59 and a half, then they have to not only pay income tax on the distribution, they also have to pay an additional tax. And that's called the 10% tax. That's the federal tax. State of California has another one that's 2.5%, but on the federal, it's 10%. So these are additional taxes that you'll see on the Schedule 2. And then for the Schedule 3, it says additional credits and payments. We will talk about at great length in 2 weeks about the non-refundable and refundable credits. And that's on the Schedule 3. So an example would be the education credits. You have an individual who's attending a college or a university, and if they qualify, they can get a credit. There's 2 different types we're going to talk about. That will also be reflected on the Schedule 3. And then we have other things like the child and dependent care expense credit, and that's something that'll populate on the Schedule 3. All right, and then moving on, this is something I use all the time. I actually use it when I teach at a couple schools, and of course I'm also a tax practitioner, and I've got all sorts of materials. It's electronic, and some of it's hard copy, and mostly I gravitate toward hard copy stuff. But the instructions to the Form 1040, they have a lot of things in that instruction booklet to include tax tables. And as I mentioned last week, I've had dozens of people ask me, especially in my practice, hey, Jerry, how is individual income tax calculated? And so, well, it's based on your filing status and, of course, your taxable income. And they go, well, how do you know that the computer is correct? I'm thinking, well, I'm not a computer programmer, but I think it's programmed correct. So what I'll do is I'll take out the instructions of the Form 1040 for the particular year. I'll open up to the tax tables, and I'll show the taxpayer the tables based on their filing status and their taxable income and the amount of the individual income tax. And they'll nod their head and say, okay. And I did mention this last week. If you're a computer person, you know that the tax software program that we use is not perfect. It's close to perfect, but you're going to see little glitches from time to time. And once those glitches are identified, then that information goes back to the programmers, and the programmers with this particular company, they will go ahead and make the fix, if you will. And again, this is something that I've seen a number of times. I don't know about the other programs. I would imagine for the other software programs that are used in the tax world, I imagine sometimes there are issues that pop up. And again, they would go back to the programmers to fix. We also talked about this last week. This is something that everybody in our program has to certify at. There's certain certification levels, and the first one would be that volunteer standards of conduct. We know it as the ethics portion. It's a very short certification, probably 10, 15 minutes of that. And then there's a publication. So anytime before you take a test, you want to review materials, go through some type of formal, informal training. And one way to do it is to open up the publication 4961, which is in Lincoln Learn on the IRS website. And you can see the various standards of conduct that we follow. Certain things that we do is we don't take money from our taxpayers to prepare the return. That's something we don't do. And we maintain confidentiality. We don't go home and tell our friends and family, hey, I helped someone out today. Their name is Fred Flintstone, and this is how much they earn. We don't do that. And we try to make a good faith effort to make sure the return is correct. So those are things that you would see in any line of work for a professional. And then the intake and interview and quality review training. This is a document, the intake and interview sheet that every VITA site, and for that matter, I know AARP uses it too, but I'll speak just to VITA right now. And so every VITA site uses this, and some VITA sites will use yet an additional intake sheet. And so right now, and I'll invoke the name of Paul Abrams. He's a great guy. He's worked with us for a while. He's come up with what we call a local intake sheet, which we'll be modifying. We'll be using it at our site. So you'll see not only the local, but also the one that we're required to use, which is the IRS intake and interview sheet, also known as the 13614C. So again, there is a publication that you can review. If you've never done VITA before, the intake and interview certification will probably take you 15, 20 minutes, if that. Okay, any questions about some of these publications that we have reviewed? All right, moving on. So we talked about the intake and interview sheet. It's actually in a number of languages. I think last year we had Spanish and we had English at the church. If there is a demand for other types of languages, I know I think there's one in Mandarin. At the site that I work at in Garden Grove, work at another site, we have Vietnamese intake sheet. So if we need additional ones, we can request them, or it's a matter of going to the IRS website where these documents are essentially housed, and it's free. You don't need any passcodes. You just simply go to that document that you want, and then you hit print. We've done that before at sites that I've worked at. And then if you are a new volunteer, you probably want to make a mental or a written note. There's a number of things that we ask you to do. one thing that we want you to do, we want you to certify. And I'm going to ask that everybody certifies at the advanced level, which I think it's a doable thing. And then what will happen when you do certify in Lincoln Learn, which is the IRS portion of the website, you're going to generate a form 13615, and that's your agreement, basically the contract between you and the VITA program and the church. And then what will happen is that particular document, it will have all of your certification levels populated, and then you'll bring it to the church when you volunteer, or you'll provide it in advance to Fred Ramos or myself, Jerry Muir, or Emily Itak. And so what we will have is we will have a repository of all of the individuals who have volunteered and a copy of their 13615 with their certification levels. And so that's something. And what I've done in the past is both as a volunteer and also as a site coordinator, I make sure that again, we have a repository of all the documents. We want to make sure we know the name of our volunteer, their telephone number, some way to get a hold of them. And so if we need to request them to come in or tell them, hey, we've got enough folks, don't worry about coming in today, we can contact them. And then of course they can answer that again through email or through telephone. And then the 525, I wish I had a nickel every time I recommended this publication. I use this publication all the time. I use it in my tax practice. I use it as a volunteer. I use it all the time. It's not a very long publication, but this publication talks about taxable and non-taxable sources of income. And I guarantee you, it doesn't matter how smart you are, how old you are, how young you are, how well educated you are. I guarantee you at the VITA site, someone will ask you a question and you will look at them and you will say, I don't know that. And that happens to me every single year in my professional practice. I get questions and say, Jerry, what's this? And thinking, I don't know, I got to do some research. And that's okay to do research. And some of our research will take a minute or two. And some of our research, it'll bubble up to a different person who can tackle that. But a lot of times your answers are going to be in the 525, which is publicly available, and it's updated every year. And then another great publication, especially for your small business owners. And I saw a lot of Schedule Cs at the church last year. There's a publication 334, and this is updated every year by the IRS. And it does a really good job talking about income, talking about expenses, and talking about deductions. And if you had an individual in your life who was self-employed and they had a small business, a lot of times they'll benefit by reviewing this document, because some people have a great idea. They're doing something for compensation as a small business owner, but they don't have the education or the skills when it talks about bookkeeping or keeping records for tax or knowing when to report. So this 334 does a really good job. And then if you are involved in the VITA program and you happen to be a tax professional, like a CTEC registered tax preparer, or you're an enrolled agent, you can get, or for that matter, a CPA, an attorney, you can get continuing education credits. And that publication 5362 talks about continuing education credits. And what that means is, and I'll use me for example. So I'm an enrolled agent, so I have to get a certain number of hours, if you will, called continuing education credit over a certain period of time. And if I don't, then I'm sent a letter by the IRS, Dear Jerry, you are no longer an enrolled agent. So try again, go through the training again, take the test, and certify again. And so continuing education, what happens is you'll keep your status. So if you're a CTEC member, we've got a lot of CTEC members in our program. They also have to go through continuing education. And there's lots of ways to do it. You can go to the IRS tax form. You can go online. There are many different educational services. You pay for them and you take the continuing education. Or if you're a member of the VITA program, you can earn certain continuing education credits. So keep in mind if you're one of those tax pros and you want continuing education credits. And then kind of pivoting to the state of California, we do not do any other type of states in our VITA program. We do the federal return and we'll do the California return. And the California return is going to be the Form 540. And the instructions to the Form 540 are just like those instructions to the Form 1040. They're very beneficial. They'll walk you through and you'll learn a few things looking at the instructions. And then when you talk about the Affordable Care Act, and every taxpayer that we talk to and we prepare the return, we have to address the Affordable Care Act. And so for the state of California, they passed a law back in the, I think in 2019, it took effect in tax year 2020. You have to show on your tax return, your state tax return, that you either had health insurance or you met what is called an exception, or if you don't, then you have to pay what is called an individual share responsibility payment. So every return we address the Affordable Care Act. And if you talk to your friends and family, not everybody, but most people have some type of health insurance. They have either insurance through their workplace, they've purchased it on the open market through an insurance broker, or maybe they have it through the Veterans Administration, or maybe they have it through the state of California through what is called the Medi-Cal program, or if they're a senior, they may have Medicare. But there's different types of ways to obtain health coverage. And for those individuals who don't have health coverage and they're out there, then what we do in our program, we make sure that we find an exception to them so they don't have to pay that individual share responsibility penalty. And what that means is that penalty is, if you don't have insurance, you don't have an exemption, then you got to pay money to the state of California. And usually when you tell people you got to pay money because you don't have health coverage, they're not happy about that. But again, we have to address that. And so a couple of forms that you're going to see from those individuals in what we call Covered California. And Covered California is essentially the state counterpart of the federal marketplace. And so when the Affordable Care Act was passed, there's a bunch of things in that particular piece of legislation, which includes the establishment of the marketplace. And there are certain states, they said, hey, we want to have our own program. And the federal government says, go for it. And so California set up the Covered California program. So we do have a lot of taxpayers in Covered California, which simply means they've gone to that particular website, they've entered information about themselves, they've purchased health insurance, and that health insurance is subsidized by the taxpayers. And because it's subsidized, and obviously they are required to file a tax return, both federal and state. And so documents that they're going to show up with at the VITA site include what we call the 1095A, which is not shown on the screen. That's the document they get, it's an IRS form. And then the state of California forms that they may have is the 3849, which is the premium assistance subsidy. And then another one is the 3895, which is the California health insurance marketplace statement. And so you're going to see those documents brought to the website, brought to the VITA site. So again, a lot of information returns. We are going to go through the rest of these in the next, I think we have, this is what, the second session, so we got 2 more sessions. So you're going to see these, you're going to work with these things, and you're going to have familiarity. And then of course, I always mention, if you can find an instruction document to a form, they usually have some great information in it. Okay, I'm going to hesitate for a moment and see if anybody has any questions or comments. All right, John, I don't think we have any questions then.
Okay, I think I'm up to date on the chat. Oh,
All
we
right.
just got a question here, Jerry.
All right, sure.
What would be some exceptions for not having health insurance?
One exception would be if you can't afford it. There's different terms that we use: indigent, poor, negative net worth, and so you're going to bump into people who don't have means. And if you don't have means, you can barely feed yourself, then you certainly can't pay for health insurance. So that would be an example. And if I remember another one, And we do see this from time to time. If you're incarcerated, that would be an exception. So if you're incarcerated in a California state prison, then there's no requirement. That's one of those exemptions. And you're thinking, well, wait a second, if you're in jail, you don't have to file a return. You would be wrong. If you have a filing requirement, the federal government and the state government, they don't care where you're at. If you have that requirement, then you got to file. In fact, I teach accounting at a prison, and I get a lot of individuals asking me about taxes. And then, of course, there's a means for them to file their tax return if they have a filing requirement. And then there's also some exemptions for what we call holy people, i.e. if you have a preacher, in some cases, those preachers, or in some cases, maybe even a priest, they would be exempt. And then also, John, we have, although I don't think we have a lot of these in California, you have members of the Mennonite faith. Those individuals would also be an example of an exception or an exemption.
Hey, Jerry, one thing, your voice was starting to fall a little bit at the end there. And then also, I mean, I think that this is one of the most complex things that we do in VITA and the returns is this one, because it's really a month-to-month test of the exemptions. And,
Yeah,
I've done a few where there's exemption for short period gap for a couple months. And then if you're out of the California for a couple months, and I've done some where you string together like 3 or 4 exceptions over the year and got out of a penalty. So it's pretty tricky, and the software I think is a little clunky. I think there's a couple places where you have to put in the data. So
yes,
that's what I'd be careful on.
Yeah, we're going to go through one of those scenarios, at least one of the scenarios where you have an individual who has covered California. And I think this is important. And again, I'll be the first to admit, and I see this on a regular basis. I'm going through software, working on a particular issue. And, I'm not the smartest guy in the world, but, I do have familiarity with taxes. And sometimes you're going to say, what the heck is this? And so what you do is you rely on your training, you go back to the publication 4012, you go back to those documents that we referenced, and a lot of times they're going to work you through the particular entries. But we do talk about covered California. We will use those examples. I think we have that for session 3 or session 4, and so you'll have a modicum of training. But when you bump into it, if you don't know something, then you should go ahead and bubble that up to someone who's experienced. Like we've got folks on the call right now who have a lot of experience with that. We've got Scott. He's got a lot of experience with it. I know John has some experience with it. I've got some experience. So you got people who are experienced. So if you don't know something and you've looked it up and you say, well, gee whiz, I can't figure it out, then just go to someone else and say, hey, someone else, how do you do this? Or I'm stuck on this particular thing. That's going to happen. So, okay. So what we're going to do
sorry,
now,
Jerry, there's more questions here. The question said, so FTB form 3849 is no longer needed? Question mark for 22 and later.
3849 is no longer needed. Well, as far as I know, unless something has changed, certain individuals will come to our site and they will have a FTB form 3849, and they'll say, hey, I got this from the state of California. So yeah, as far as I know, that's still active.
Yeah.
It was certainly needed last year.
What's that?
It was certainly needed last year.
Yeah. And what does happen for the folks on the line who are new or newer, again, things change. And sometimes when something changes, someone will bring it up at the VITA site, and we'll get together and say, haven't seen this one before. And so we'll look at it, we'll reach back to the state, we'll reach back to our representatives, whether it be the IRS or the state representative, and we'll say, hey, what's the deal here? This is going to happen. This is not going to stop operations. It may slow a particular return down, but at the end of the day, we're going to find the answer because we have those people who are, again, our state and federal representative, and we can go ahead through the VITA program, and we can find the answer. Collectively, we can. Okay, so a couple things I want to point out. Oh, John, one more?
Yeah, just one more question. What happens if there is a correction to the software that affects a return that was filed already? And I remember one instance a few years ago when unemployment insurance was not taxable for particular, I forget which year, maybe it was 2020. And then it was kind of, we had already filed a bunch of returns. So in
Yeah.
that case, we did nothing and it was automatically corrected. I don't know if there's another one where it's not a law change, but let's say a software glitch, that an error.
Yeah, what
I wouldn't
happens
sure.
is
Yeah.
when there's a software issue, then one of two things can happen. One, it's fixed automatically, and then the taxpayer is notified, hey, you're going to get a greater refund or a smaller refund. Or in some cases, we have to fix it. And when we fix it, if the return has already been electronically filed, that means an amended return has to be generated. So those are the two options. But again, keep in mind these software glitches, if you will, they do not happen on a regular basis. It's not like we have 20 or 30 per season. We might have one, we might have two. But again, as those issues are identified, we'll share it with everybody, and then we'll come up with a solution, or the IRS and FTB will come up with a path forward, a solution for that. And again, that's going to happen. I mean, you can get frustrated, and I've been frustrated in the past by these mistakes. It's like, you just got to deal with them and move on. Okay, speaking of moving on, what we're going to do is we're going to introduce you to a basic tax return, and then we're going to talk a little bit about it. But before we do, this URL at the very top here, that's how you get to the IRS website. And we'll talk about the certification level, and we also talk about the use of the practice lab. And then talking about the practice lab, the software for the practice lab has been posted. It's been hung on the IRS website. And so if you want to start practicing utilizing 2022 tax year software, it is available. So that's a good thing. So let's do this. We have a little bit of time before our break. Let me go ahead and stop sharing and see if I can bring up the software here. And John, do we know how many new folks we've got on our call?
I just know that there's 53 participants. I have no idea who's new or who's
Okay.
not. Yeah.
All right. And so if you're brand new, I would encourage you to grab a pencil unless you can memorize a whole bunch of stuff. And so what happens is everybody in our program, whether you are a returning volunteer or you're a brand new volunteer, everybody's going to certify at certain levels. And this is my request. If I get shot down by someone who's higher up than me, then so be it. I'm going to ask that everybody in our VITA program at St. Killian's certifies at the advanced level. I'm also going to ask that you certify at the basic level first, and then you go to the advanced level. So there are certain levels of certification. If you work at my VITA site in Garden Grove, which is not associated with the church, all of my volunteers have to be certified at the basic, the advanced, and the military level. And so again, we have certification. We will talk in length about certification probably at session 3 or 4, but you can see up here where it says certification paths. And this is the important thing. When you start to certify, you want to make sure you have read the material, you've done some of the practice, and then you have those reference documents at the ready. And then you have to register to utilize the certification paths, which means you have to provide the IRS contractor your information and know you're not going to be contacted to be sold anything. You may be contacted for a survey. So you've got to register to use this. And then if you're like me, and I forget my passwords all the time, you got to write them down. You got to write that stuff down because you want to be able to utilize the certification path as opposed to going through a recovery of a password. So that's what you got to do, step number 1. And then this landing page, this has a lot of information. And one thing it does have is this practice software. And so we're going to go ahead and open that up and jump into our Billy Franco return. So the international password, if you will, is Train Pro Web. And
wait, what is that password?
It's
password?
Train Pro Web, TrainProweb.
Thank you.
All uppercase, all one word. And then you can see the material that talks about VITA, talks about the publication 4491. I mentioned last week, I mean, I'm not saying this is a bad publication. I don't use it. I think it's too busy, but if you like it, go for it. And so once you hit Train Pro Web, then it'll bring you to this particular portion of the software. And you also have to sign in to utilize the software. And so if you are brand new, you'd hit create account. And this is important. You'll populate this screen with information that you're aware of. And so, for example, you're not going to be aware of site identification number. You can leave that blank. But you need to provide some type of email, whether it be work, school, personal, whatever the case is. You're going to create your username and password, and you're going to select the program. And probably for most of us on the call, it's going to be VITA. And there are different types of programs, but you can select VITA. And then you want to select a security question and a security answer. And then you have all that information written down so you can go ahead and create an account. And then once you create an account, you'll come back here and you'll sign in to use the software. So give me a minute here and I'll sign in. And then this landing page right here, this is a very, very busy landing page. And if you're new or newer to the program, the three things that you probably want to review or look at or be aware of is go to practice area, the big blue tab. That's how you utilize the software. You'll click on go to practice area. And then sometimes individuals, they want to go ahead and get some additional training. And so my recommendation is go to section 4. These are tutorials. Some of them are a few minutes, some of them are a few minutes longer than that. And it shows you how to prepare returns. They have an individual, an employee from TaxSlayer who will walk you through the various topics. And then if you want to utilize what are called practice returns, you can go over here to section 6 and you can utilize these returns. Essentially has a fact pattern, and then it has what are called check figures. And those are the terms that accountants use where you complete your return and you would compare it to the check figure to determine if you're correct or not. And then one of these returns, and I forget which one, it talks about a married filing separate couple. You can ignore that because in California in our VITA program, we do not prepare married filing separate returns. And so if you have someone who drives up or comes up to the site and says, hey, I'm Wilma Flintstone and my husband is Fred Flintstone, and I'm not going to file a joint return with this husband of mine. Then you say, okay, then what are your plans? Well, I want to file separately. We cannot help you at St. Killian's. We're not trained to do that. And I think my wife says it best. Would you go to a mechanic who is not a brake mechanic and say, mechanic, would you fix my brakes on my automobile? The mechanic says, I'll be happy to do that, but I'm not trained. You'd say, oh, wait a second. No, I'm going to go somewhere else. And so that's somewhere else for a individual who's married filing separate is not going to be a VITA site in California. It's most likely going to be a paid professional or someone else. And so that's something we just don't do. We don't need married filing separate returns. And so now we're going to go to the practice area. And you can see right here, this is a screen that shows you the tax program. And so when you open up your software, the software that you're going to use in the VITA program for live taxpayers will have more than 2 years, but your focus is going to be 2022. And yes, we do prepare past year returns. And so if you go to the upper right-hand corner, you're going to see where it says change the tax year. And in the practice lab, we only have 2 choices. In the real software, you're going to have more than a few years there. But again, these are the 2 choices. Now, for our purposes, on the first return, we're going to go ahead and use the 2021. And then you can go to the upper left-hand corner, you can see the 2021 tax program. And then the one we're going to do later on this afternoon, we're going to jump into 2022. And so if you've entered information and you want to bring up the return, then you would hit client search and you'd go ahead and put in the name of your client and then off you go. But if you're trying to create a new return or start a new return, you would start here with this gray tab that says select. And you're gonna plug in your social security number. And let's see, let me throw one in here. And then sometimes you're going to see something like this. Social Security must match. So what that means is you've got a Social Security number you typed in, and then you typed in a different one. So let's go and type in the same, and you can hit the return. Start return, and then now you're in the software. So this is something you can see at the VITA site. Everybody has to have a filing status, because when you determine individual income tax, you're looking at the filing status, and you're also looking at the taxable income. And this is usually not a bridge too far, but what's important, you might want to make a note. In your publication 4012, you have a decision tree, and it's a really good tree about what status an individual should or must use. And so just a couple things. Single, you're looking at the marital status at the end of the year, which would be December 31st, 2022. And you will see this. I see this from time to time. I've probably seen it maybe 50 times, both in my practice and both in VITA. I will ask an individual, are you married? And they will stare up in the sky and they will start thinking. And they're not trying to be difficult. They don't know if they're married or not legally. And so what I've told people, if you don't know if you're married or not, then call the clerk of the court and ask that clerk if a judgment has been passed by the judicial official, the judge, or the magistrate, and has a divorce decree been issued. And that takes a phone call, and most likely they're going to do it and come back to the site. But there is a way that you can find out if someone is divorced or not, and then the date of the divorce. And then married filing joint, this is an election. People choose to do it. A lot of people think that you have to file the joint return with your spouse, and you don't have to. It's your choice. It's their choice, and no one can make you do it. The government can't make you do it. A court can't make you do it. It's your choice. And most of our married couples, they do want to file jointly because we don't help them in a married filing separate return. That's outside of the scope of the VITA program. Head of household can be one that's a little bit more involved, but certainly not impossible, because you'll use the decision tree in your publication 4012. And the head of household talks about being unmarried and then having typically minor children that you're caring for in your house, or you're considered unmarried for tax purposes. And that'd be a situation where the one of the spouses has left and they're gone the last 6 months of the year, and they're not coming back for whatever reason. That individual then could qualify for head of household filing status. And then qualifying widower, we see this a lot. You've got someone, their spouse has passed away, and then the surviving spouse still has dependent children they're caring for. This is a status. Now, if you have a situation, and we see this a lot, an individual will come in and say, I've lost my spouse this year, i.e. 2022, and we'll say, understood, do you still want to file jointly with your spouse? You can be the individual signing the return for the decedent. And the survivor says yes. And so that would be a situation for just that year alone, the year of death, where they can sign married filing joint. And so I always tell people, if you're a little fuzzy on this, go to the decision tree. And when you're at the VITA site, you should utilize that decision tree when you're determining filing status. Okay, so this individual we have, his name is Billy, and he's filing as a single person. And let me go ahead and populate this. I mentioned last week, and I'll mention again, when you're talking about individuals' names, you want to make sure you're going to use the names that are reflected on their Social Security card. So in the program, the VITA program, we ask for a copy of their Social Security card, or a document that's issued by the federal government that has their Social Security number on it. For example, the SSA 1099, which is the Social Security statement that seniors get who are on Social Security. Date of birth is another item that we collect, because if you have the wrong date of birth and we try to electronically file the return, then what happens is the return is rejected. So this is all captured on that intake and interview sheet. Occupation, we're going to capture that, but it's not a showstopper if you know what I mean. Okay, there's a lot of things in the software that you're not going to use. And so we're going to go through just a couple things right here for Billy, our taxpayer. You have one that's blind. This is the tax definition of blindness. You can see that in the in the session one that we talked about, we will have taxpayers who are deceased. And what that means is we have a surviving spouse that comes in. We have a brother or a mom that comes in and says, my son has passed away, and I want to file that final return for that individual. So we're going to ask for a death certificate, and then we're going to indicate in the software that the taxpayer is deceased. And then what happens is when there is a death certificate, IRS, they have a database, which is a massive database. As people pass away, then of course, you file a return. If the person's dead and you don't say the person's deceased, then there's going to be an issue the IRS will kick out. This is something you're going to see in a lot of things. Don't get into a political discussion. To say, taxpayer, do you want monies to go to the presidential election campaign? And when people ask me, what is that? I say, well, it was established by Congress. And what that means is if you want to issue an order to the federal government to segregate or separate $3 of tax monies, not your tax money directly on the return, but tax monies, and to go to this fund. And then what happens is when people qualify, then they can get money from the federal government to run their campaign. And so a lot of people say, yeah, sure, I'll do it. This combat zone thing, you can ignore that. If you do have a member of the armed forces who comes to the site and they've got a W-2 from the military, we're not going to assist them because that's something that requires military certification in the VITA program. And then a few other things. We talk about virtual currency. I'm not a smart guy in virtual currency. I've gone to a couple classes, but this is what I know. When you're talking about virtual currency, like Bitcoin or some of the other ones, when someone buys it, they now have what is called a capital asset, which means they have an asset. And if they end up selling that asset, then they have to report it on their tax return. They may have a gain or loss. So if you buy capital assets, i.e. virtual currency, and come to the VITA site, we can help you out. If you sell virtual currency in tax year 20, in this case, 2021, we will not help you out at the VITA site. We're not going to do that. And so unfortunately, some people sell virtual currency and we say, hey, can't help you. And of course, it'll beg the question, well, where do I go? Well, there's a lot of places you can go. You can go talk to your friend. You can talk to a trained professional. You've got enrolled agents, you've got CTEC members, you've got CPAs, but unfortunately, we can't help you out. And that's part of what is called the scope of service. And then down here, a lot of taxpayers, like for example, English is not my first language either. And so there are certain people, they want written communications from the IRS in their own language, their language as a kid, if you will. And maybe it's Spanish, maybe it's Vietnamese, maybe it's whatever. And so you can click there and then you can indicate the language. And you can see there's a short laundry list. It doesn't cover all languages, but it covers a whole bunch. Okay, so in this case, we're good to go. And then we have to populate the software with an address. So I'm going to go ahead and put in an address. And then you do see the auto population of the software. If it auto populates and you say, hey, wait a second, that's not correct, then you simply go to the box, delete what you need to delete, put in what you need to put in, and you're good to go. As far as the returns, we don't do part year returns. We only do a California state return and a federal return. And in some cases, individuals will say, well, can you at least do my federal return, even though I'm from Arizona or New Mexico? We can do that, but we're not going to do, and we're not going to file their state return unless it's California. And they want to capture a phone number. We do have to reach out to our taxpayers and ask them information from time to time. So you want to get that phone number. And if it's a married filing joint, you want to get that phone number from their spouse. And then of course, your email address, we have that on the intake form. You want to make sure you capture that. Okay, I think, John, before we continue, I think this is probably a good time to take a break. I've got 9:59. So why don't we take 10 minutes and come back and we'll continue.
Can I give you one more question, Jerry?
Oh, sure.
Yeah, so this one I answered, but I think I answered the wrong question. So suppose someone comes into a VITA site and we're going to do their 2022 return, but then they all say, can you do my 2021 return, which is fine. Does the VITA volunteer need to be certified for the past year? Or can they just be certified for the current year and do a prior year's return? I hadn't even thought of this question before.
Yeah, what I remember, and I think this has changed, but what I remember, and this is what I'm going to do unless I'm told differently, if you're certified for 2022, then yeah, you can tackle 2021. But this is the important thing to remember. If you have someone with 2 tax years, they're going to have to complete a separate intake and interview sheet. And then our priority will be 2022. And so that's how we're going to do it. And again, keep in mind, tax law is going to change. And so what may happen is you may do the 2022 and life is good, but then we may say, you know, something, you're new to the program and we love you. That's great. But because of all these changes, we're going to give this 2021 to one of our other volunteers who's been here for a few years and worked 2021. And that makes sense because again, there's a lot of changes between 2021 and 2022.
Okay. All right. Thanks, Jerry.
Okay, we'll be back in 10 minutes.
Hey, Jerry.
Jerry just left.
Oh. Hey, John, it's Phil Shakirlian. How you doing?
Hey, how you doing?
Good. I can't log into the practice lab for some reason. It's Train Pro Web, right?
Right.
And it's all capital, or all lowercase?
Yeah, all cap.
All cap. That's why. There we go. Okay, perfect.
All
Thanks.
right. Thanks.
Bye.
Okay, John, we're going to get started again. And so now we're on the second page of the software. It talks about the California return. It asks about whether or not there's been a name change. Typically, the answer will be no. Very few people actually legally change their name. And when you do change your name, you do have to go to court. You just can't wake up one day and say, I am now so-and-so. You got to go to court. Once that happens, then your name is changed with the Social Security Administration. Down here, the credits talks about the renter's credit, which is a non-refundable credit. And that's a California state credit. And some of our taxpayers are going to qualify for that. And what that means is they've paid rent on their home or their apartment that's based in California and has to be for 6 months or longer. Use tax, we typically don't see that. That's when you buy a big ticket item outside of the state of California. You bring it back into California. You use it in California. An example would be a car or recreational vehicle. And then, of course, the difference between the tax rates in the state you bought it in, let's say you bought it in Iowa and you paid 6% sales tax, you bring it to California, you pay 9%. That difference at 3% will be use tax. And then, of course, if you do pay use tax, you'd pay it typically either to the DMV or you'd fill out a form and you would pay it to the California Department of Tax and Fee Administration, which is the CDTFA. So in this case, the example is no, it's 0, and it's no. This is something that we have to ask every taxpayer. Do they have what is called minimum essential health coverage? And that's under the Affordable Care Act. And in this particular case, he does. He's going to have it through his employer. And then if you have someone who is in covered California, then you would indicate yes or no. In this case, he's not in covered California. He has insurance through his employer. And then it asks about the address. Is it the same as on the tax return? And typically the answer will be yes. And then we'll make this individual from Orange County, California. And for those of you who are new or fairly new to the VITA program, you will probably be fairly proficient after you go through the software a couple 5 or 6 or 10 times. And then I think this software is pretty easy to use. It is user friendly, and I think you'll master it very quickly. Okay, in this case, no dependents, but for our next one, we do have dependents. And so what that means is they have to meet the rules of a qualifying child or what is called a qualifying relative. And that document talking about those two statuses is in your publication 4012. So the answer for this one is no, no kids. And then you have the income section. And then like I always tell people, you have 3 different types of taxpayers. You have wage earners, you have self-employed individuals, and you have investors. And in some cases, you're going to have a taxpayer that's going to be all 3. And in the VITA program, most of our taxpayers are wage earners, most of them. And so in this case, we do have a wage earner. And we use a mantra in the VITA program. It's called, you key it as you see it. And so what that means is they're going to have a W-2, which is a wage and tax statement. And we're going to go ahead and look at that document, and we're going to enter it in the software as we see it. Sometimes you'll have a taxpayer who will have it on an electronic device, cell phone, or some type of, again, electronic device. And we can go ahead and use that. We'll simply view it, and then we'll key it as we see it. But a lot of times they'll have it printed out. So EIN is the employer identification number, which will be on the W-2. Key it as we see it. And then in this case, you have a auto generation of an employer name. If that is correct, great. If there's a mistake, then well, actually we key it, we see it. So we'll leave that alone. All right, and we come down here to wages. Usually the only section you're going to concern yourself with will be 1s, 2, 3, 4, 5, and 6. That's usually about all you're going to see. So wages will be reflected on the W-2. In this case, he makes $50,000. And in our program, it's usually about $60,000 of income. I know in the past it's bubbled up to about 66,000. So that's kind of written in hard jello. So if someone comes into the site and they've got a W-2 and that's all they have, and it's $65,000 or $66,000, we're going to help them. If they come into the site and they've got a W-2 with $100,000, we're going to say, hey, you're outside of the scope. You make too much money. And of course, usually there's going to be tax withheld. And then you see the auto population in 3, 4, 5, and 6. And that's based on the FICA rate, which is Social Security, 6.2%. And then the Medicare rate, which is 1.45%. And sometimes you're going to see the auto population is not going to agree with the W-2. So you go to the box. In this case, let's say it's 724, and you make that change, and you're good to go. And then sometimes you might have what is called a verification code, and this would be used to mitigate fraud. And if that's the case, you would enter that. Again, key it as you see it. For box 12 and 14, box 12 is going to be a number of codes. And typically, and all of these codes are described in your publication 4012, but typically you're going to use D as in Delta, which is deferred compensation, like a 401k, or Delta Delta, which is health insurance premiums paid by the employer on behalf of the employee. And in this particular case, they being the employer, they paid $7,000 for this individual to have health insurance. And then over here in box 13, usually the only one we're going to see is a retirement plan. And that means we're going to indicate they have a retirement plan. That's important because sometimes you're going to have a taxpayer that has both a retirement plan at work and they've made a contribution maybe to an individual retirement arrangement. So you want to make sure you check that. And then over here in box 14, this is your occupational insurance. This is a requirement for not all taxpayers in California, but a lot of taxpayers. And so you're going to see this California State Disability Insurance, and you're going to key it as you see it. And so what that means is the employee pays premiums. The employer then remits this to the state of California. And then when the employer becomes sick or injured, and if they qualify, they can get on state disability. And this is something you're going to see for, like, for example, expectant mothers. They're going to be told by their doctors, hey, you should take off work. And they take off work, they file a claim with the state of California, and then they get their disability payments for a period of time. And then for state information, and again, the only state we attend to is the state of California. Stay away from those pleads. Hey, can you do my return? It's from New Mexico. It's really easy. The answer is no, we're not trying to do New Mexico returns. And so what you want to do, we can help them with their federal return. You will see that from time to time, but we're not going to e-file their New Mexico return, just California. And then your EIN, which is your employer identification number, you'll key it as you see it. Typically, box 16 will be the same as box 1. Federal and state wages typically will be the same. Box 17 is state tax paid, which means state income tax withheld by the employee and then subsequently remitted by the employee, by the employer, and then subsequently remitted by the employer to the state of California. That's what that means. So state tax is withheld. In this case, we'll say 2,000. And then 18, 19, and 20. This is something that you don't attend to. This is for jurisdictions that have individual income tax, like the city of New York, the District of Columbia, the city of Detroit, Michigan, but we don't have any of that in California. So we'll hit continue. And then if you have another W-2, and you're going to see this a lot in the VITA program, someone may have 2, 3. One time I saw 17, and that means someone worked for a couple weeks and then they went to some other job. You see this in the entertainment industry very frequently where someone has multiple W-2s. And so you simply just add another W-2. If you need to make a revision, which happens all the time, you'll hit that blue pencil. If you've garbled an entry and you want to make it go away and start over again, you would hit that red garbage can and the entire entry, in this case, the W-2 entry, would go away, and then you can start anew. All right, we're going to hit continue. And in this particular case, we did have a 1099 INT. And so what we're going to do, we're going to go to the tab that says interest income. Click here. And then your choices are the 1099 INT, or if you have a dividend, in this case, it's a INT. And you're going to go ahead and you're going to ask the individual for a copy of the information return. And then we're going to go ahead and put the information in the software. And the mantra is you key it as you see it. And then box one, typically that's what you're going to see in our program. In this case, he had $15 of interest. And then on your certification, they ask about an early withdrawal penalty. And then what that means is, let's say you go to the bank and you set up a certificate of deposit, you deposit $10,000, you sign a contract with the bank, you're going to keep the money in there and they're going to give you a certain amount of interest. And then let's say, I've done this before, you went to the bank and said, hey, I'm young, I'm irresponsible, I want to cash in my certificate of deposit, I want to go to Vegas. And the bank manager said, well, we're going to have to charge you a penalty on the interest. I said, I don't care, I want my money. And so what happens is they'll give you your money and then they'll send you a 1099 INT with the amount of interest that you earn, and then that penalty, i.e. the amount of interest that you would have earned per the contract, but you broke the contract. So sometimes you'll see that. And then every once in a while, you're going to see federal tax withheld. And again, we key it as we see it. And then sometimes in your 1099 INT, you're going to have foreign tax withheld. And what that means is that would be tax that's paid, foreign tax that's paid to a foreign government. And then you may be able to get what is called the foreign tax credit. We do talk about that, but for now, when you hear about the term foreign tax credit, it's usually a modest amount of money that will be a benefit to the taxpayer on the return. And then all these other boxes, typically you don't attend to those in the VITA program. You usually don't see that. Okay, so we're done there. And then if you have an opportunity to go to the document that said Billy Franco tax return exercise, there's a discussion about he went to a real estate school in 2021 to most likely get his real estate license. We will talk about this when we talk about the education expenses, but let me go ahead and just show you right now when we're talking about education expenses and how that works. And so in the credit section of your software, there's a discussion of education credits, and there's two types of credits. We have the American Opportunity Credit, and then we have the Lifetime Learning Credit. And there are a lot of rules for these particular credits. Well, one of the rules is the institution, the school, has to issue a Form 1098-T. And then if you want to get one of these credits, your school has to participate in the United States Department of Education grant and loan program. And so if you go to a real estate school, they're not going to participate in that grant and loan program through the Department of Education. And so for Billy, who went to a real estate school, that's not going to be something he can take as an education credit. So you simply won't put it on the return. And then let me point a couple other things out. Again, we're in 2021. And so if you're new, you want to make some notes. Health insurance. For health insurance, everybody's going to come to the site with documents. It'll be the 1095A, maybe the 1095B, 1099C. But if they have the 1095A and then the corresponding franchise tax board documents, what that means is they're in covered California, which means they have to file a return. And so you would indicate yes, and then you would follow the prompts. We're going to go through this in a later session. But for now, Billy is not in covered California. His insurance, health insurance, is paid for by his boss, his work, but he does have health insurance. So we'll indicate no, he's not in covered California. And we're going to indicate that. Sometimes you'll see at the VITA site, taxpayers will say, hey, I am in covered California, but I don't have my 1095-A. And so what we do is say, well, you got to get that. And so you maybe come back next week. We'll enter what we can here, but you got to have that document, because again, if you're in covered California, it does mean that you are subsidized by the taxpayers. And part of the process of filing a return and going through the reconciliation, we are going to determine if the subsidy was too little or if the subsidy was too much. If the subsidy is too little, then you're going to get the premium tax credit. If the subsidy is too much, then you're going to have to pay something back through the excess credit. And so that's really important. So again, we can help them. And there's a way to get that document. They can go to Covered California. In some cases, they'll go to what is called the Navigator. And the Navigator at maybe a social service agency can help them generate the form, California forms, and then the form 1095-A as an alpha. So the state return, most of the returns that we prepare will be both federal and state. And a lot of times you're not going to jump into the state return unless you have to make entries. So let me just point a couple things out. Again, blue pencil, you're going to make revisions. Okay, it asks about county residence. Okay, continue. It asks about the address, same with the return. Continue. Minimum essential health coverage under the Affordable Care Act. Yes, through his employer. In covered California, the marketplace. No. And then you're going to come to this screen, and just a few things that we want to mention right now. Again, we're going to spend time in the California return in later sessions, but this is something you want to be aware of. Additions to income, some of these will automatically roll over, if you will, from your entries from the federal return to the state return. But in covered California, there's a term called conformity, and there's a term called non-conformity. And so I'll tell you about conformity. Conformity would be, for example, in this tax return, we've got wages of $50,000 reported on the federal return and reported on the state return. That's called conformity. The state of California conforms with essentially federal tax law. Here's an example of non-conformity. Non-conformity would be you have someone who has unemployment compensation, which is taxed by the federal government, and that is not taxed by the state of California. That's called non-conformity. And so that means that would be a subtraction from income. But again, this should be taken care of automatically. Certain things are taken care of automatically. Certain things you've got to jump into the actual return itself. Other examples of items that are not taxed by the state of California. You might remember I think it was last week, just a few days ago, where somebody in California won the Powerball, which is considered, I guess, part of the California lottery. And that amount was $2 billion with a B. Of course, once you do the math, you take out federal taxes, and it depends on a lump sum payment. But anyway, they're going to have a lot more money than I have. So that's going to be taxed by the federal government. The state of California will not tax any of those winnings. And so that's an example of non-conformity. And then yet another example of non-conformity, which is taken care of automatically and by the software, is you're going to have individuals have Social Security. And then what happens is on their federal return, a portion of their Social Security may be taxed. On their state return, California does not tax any Social Security. So that's another example of non-conformity. And then vice versa, you have other things that are taxed by the state of California, but not taxed by the federal government. And so, for example, you might have someone who has been recently divorced, maybe in 2022 or 2021, and maybe they're receiving a small amount of alimony income. Well, for that divorce that occurred in 2020 or 2021, the federal government is not going to tax the alimony income. However, the state of California does not conform to that. The state of California will tax that alimony income. And then when you look at alimony, the rules change for divorces after 2018. And so you want to make sure you look at that portion in your publication 4012. And then other things that we're going to talk about at length when we jump into the California return. will be obviously the healthcare coverage forms. These are the two forms that are brought to the site by people who are in covered California. If they're not in covered California, they're not going to have these forms. And then other things that we're going to talk about later on, we're going to talk about what are called itemized deductions. When you hear the term itemized deductions, you're going to have a Schedule A as an alpha on your federal return. And then what happens is a lot of these itemized deductions roll over to your state return. And then sometimes you have to go into the California state return for itemized deductions and make certain adjustments. And we're going to show you how to do all of that for California in a later session. And so again, you can get into the California return, you can make changes. And when you're all done, you'll go ahead and exit out. All right. And so what we did here is we attended to the income section. We talked about the health insurance. In this case, we didn't make any changes to California. And now we're at what is called a tax summary or tax return summary. And I just want to show you a couple things. When you generate a tax return in the software, every taxpayer is going to receive a courtesy copy. So we're going to print out once we verify everything's good to go, which means it's quality reviewed. And then we're going to print out a courtesy copy to the taxpayer. And the taxpayer is able to take that copy with them, part of their records. And when we do generate a return, we are going to review it with the taxpayer. But here's the however. You're not going to review the entire return line by line, page by page, because in some cases, if you were to do that, it would take hours, and that's just not going to work. But what we do want to do, we want to do a courtesy. We want to do a little bit of an education, if you will, to our taxpayer. So we'll talk about certain lines. We'll talk about certain income lines. In this case, wages, W-2, interest income on line 2 Bravo. Everything rolls down to the total income. And when you hear that term AGI, it simply means your income or total income less your adjustments. And the difference is AGI, and that's reflected on line 11. And keep in mind, this is a 2021 return. And then that standard deduction, it's going to be generated. And sometimes your taxpayers, they're not going to be aware of the standard and itemized. They think sometimes they can get both. And so I usually go to the taxpayer, and I'm not an English person. I don't know if this is a preposition. All I know is that's the word or, O-R. And so I tell people you either get the standard deduction or you get the itemized deduction. And for most of our taxpayers, they'll be getting the standard deduction. Over here on the left-hand side, this is for most taxpayers. There will be some changes for seniors. If you're 65 or older, you get an additional amount. And if you're blind, according to the tax definition, you get an additional amount. But in this case, he is a youngster. He's under 65, and he's going to get that standard deduction for single individuals. Now, right here, this is only for 2021. This is that item that Congress says you can get charitable contributions up to $300 if you're single, if you're making cash contributions. This is for tax year 2021. In 2022, this particular item goes away. So if you make a charitable contribution in 2022, it will all land up on the Schedule A if you itemize. All right, and so you have this, and if you have a calculator, great. If you don't, you can probably do it in your head. So here's your gross, your AGI, you subtract your standard deduction, and you're going to end up with taxable income. And so once again, the software is going to go into the program. They're going to look at taxable income, and they're going to look at filing status. And then what will happen is on the next page, which is line 16, you're going to see what is called the tax. This is the individual income tax. And then sometimes people get confused because there's other type of taxes. So you just tell them there's individual income tax, and there are different types of taxes, like the self-employment tax. There's an additional tax on an early distribution. And all of that, again, will be reflected on the 1040. In this case, this is all he has. And so I would, and I do this with my VITA clients. I do this with my paying clients. I always refer them to line 24, and I'll hesitate for a second because I want that person to know that they have paid or will pay this tax. And so even though they're going to get a refund, maybe they still have to pay individual income. Excuse me, they still have to pay tax, and that tax is on line 24. And so you see the difference here. They've got the withholding of 5,000. They have paid or will pay tax of 42.98. And so the difference is going to be that refund. And then what I want to do, I want to go back into the software. And if you're brand new, you want to make some notes here. So we're going to go back into the software. And we're going to show you this concept called the recovery rebate, which you will not see in tax year 2022. So we're going to go to deductions. And then we're going to go to our credit menus. And we're going to go to the recovery rebate. And so just a word on this. So again, we're looking at tax year 2021 right now. You will not see this on the 2022 return because Congress didn't provide for it. So what happened in tax year 2021, a lot of people received that federal stimulus payment, and that was the third one. And so if they got it for 2021, tax year 2021, you would indicate that, and they received a notice, and you would put in the dollar amount that they received in their federal stimulus payment. If they didn't receive one, you would check no. And then what would happen is the software would calculate this recovery rebate credit. And so what that means is taxpayers either received the third federal stimulus payment, and if they didn't, then they're going to receive this recovery rebate credit on their federal return. And again, only for 2021. For tax year 2022, you will not see it on the live tax Slayer program. You will not see it. Okay, so now we're going to go back into our return, and we're going to see how that changed things. And we're back to our tax return, and we're going to go all the way down to our taxable income. No change there. We didn't change that. And now we're going to go back to page 2, and we're going to show you how it changed with the recovery rebate credit. In this case, the taxpayer got the recovery rebate credit, which is considered a prepayment. And so if you add the 5,000 plus the 1,400, then you see total payments of 6,400. And then you match this against what the individual owes, and then that generates a refund. Now, right now in the practice lab, I checked, I think it was yesterday or the day before, you do see a tab for the recovery rebate credit for tax year 2022. That's in the practice lab. In the live software, it will not be reflected. So just a couple things, and we talk about this in finishing return. This is really important. A lot of taxpayers, they want to have what is called a direct deposit, or if they owe money, they want a direct debit, which means money taken directly out of their bank account to pay their tax. In this case, he's going to get a refund. And so if he wants direct deposit, he would provide you with a routing number, an account number, and of course, the name of the bank, and then the type of account. This doesn't happen often. Unfortunately, I've seen it probably about 3 or 4 times. And when it happens to the taxpayer, it's a big deal. Taxpayers have provided incorrect account numbers to us in the past. And then what happened is monies went to another account. And taxpayers would call us up. They would call me up. I was a site coordinator at a site, and they go, "Hey, what about my refund?" And we do the research and say, "Well, it went to this account, and that's the number you provided." And they say, "Well, no, that's not my account." Well, you know, we can't call the IRS, and we can't advocate on their behalf and say, "Hey, change this." And so this is an issue. We can give them some guidance on what they need to do to get it fixed, but there will be a delay. I had one of my clients provided an incorrect account number, and the IRS could not make a deposit, and contacted the taxpayer and say, we can't make a deposit. We're going to give you a paper check. And so this guy waited about 2.5 months for his paper check. So I think the takeaway here is you want to make sure that's the right account number. You want to look at the document from the bank, and it may be electronic on their iPhone or whatever, but you want to make sure that's correct. And then that way the refund's going to go to their account. And usually that goes in within about 5 to 10 business days. All right, so I think that's about all I want to talk about here. And so John, I'm going to hesitate for a moment and see if there are any questions about this return or anything we talked about.
Yeah, there was a question. It came in a while ago about name changes. If somebody has a name change from one year to the other, should you use the old name or the new name? I'm guessing that you should use the new name, and then the social security number is going to carry forward. And then similarly, if we're uploading, a prior year return, because we save the information from prior years, that you can change the name for the new return. It'll auto-populate, but then you can override it with the new name.
Yeah, and
Yeah.
chances are you're probably not going to see that, but if you do, then if someone says, hey, I've got a new name, then usually they're going to have a court order. And in fact, I remember one time a guy said, hey, I got a new name. I said, okay, what's your new name? I said, do you have a court order? He goes, yes, I do. He showed me the court order. He showed me his new driver's license with his new name. I said, okay, we're going to use your new name because obviously this information has been provided to Social Security. And this is another thing, you'll hear it, although you're not going to be involved in perfecting returns. You might hear someone's return was rejected electronically. So we'll try to perfect it a couple times. And then what happens is if we're unsuccessful, we say, hey, we're not going to spend weeks and weeks on this thing. We're going to hit print and we're going to say, you need to go ahead and send your tax return in utilizing the United States Postal Service. And that way you have filed your return. Make sure you sign it. That will happen from time to time. And at my site in Garden Grove, we usually try 3 times to perfect it. And then after that, I tell my folks, we're done. We're going to contact the taxpayer and say, you need to file your return. We are not going to electronically file. I'm not trying to be mean, but we just can't, in some cases, perfect a return. And that's just the way it works. So, but again, the vast majority of our returns, I think well over 95, probably 98% of our returns are electronically filed. All right. Any other questions, John, or are we good to go?
Jerry, this is Barbara Harris from Laguna Woods. Regarding the banking information, before we hand over the return to the client, we have that summary sheet that comes out on our print queue thing, and we make them initial their name, their address, their telephone number, and confirm their banking information before we even go over the return with them. So we found that to be very helpful because even though people have initialed their address, it was still wrong. So, but we actually print out that summary sheet, make them confirm all the basic information, and especially the routing and account number.
Barb, that's an excellent idea. I had one of my paying clients. He's a senior citizen, and he gave me a bank that he probably had when he was, maybe 55 or 60, and yeah, that. So now in my paying practice, I do the same thing. I have my client's initial. We look at the return. Look at the account number and all the bank information. And they initial. And it's not like we're trying to play gotcha. We want to make sure the refund goes to the individual's account. And if you ask me right now, Jerry, what's your bank account number? My answer is, I don't know. Got to go look it up. And that's probably the same for a lot of people. So that's okay. Thank you, Barbara. That's a good point.
The other argument we get into with our clients all the time is they want to give us a deposit ticket, and the routing number on the deposit ticket differs from, in some cases with some banks, differs from the routing number on the check. And so then we get into this discussion where they go home and bring back the check and confirm that the routing number is different.
Yeah, that's important. Also, when you're talking about routing numbers, they are not a state secret. You can go and you can Google a routing number for any financial institution in the United States, and it'll pop up on your screen. Now, what is a state secret is the account number. But yeah, you want to do that. And sometimes they'll call the bank right then and there, and that's okay. But yeah, we want to make sure it's correct. And that's why the extra step of confirming, and in some cases, reconfirming. All right. Okay, John, if there are no questions, then I'm going to go ahead and pivot, and we're going to go back to our PowerPoint presentation. Okay, so that was the that was the tax return that we prepared. And again, going back to this real estate example, in order to receive the education credits known as the lifetime learning credit or the American Opportunity Tax Credit, you have to be going to a college and or university that participates in that grant loan program administered by the Department of Education. And in some cases, you may have a student who's attending, like I knew this guy, he went to Notre Dame. I forget which state it's in, Indiana. I think it's in Indiana. And he went there and he was a student for, I think, 4 years. And then for one semester, he went over to Rome. He was an architecture student. He went over to Rome, Italy, and he was there for about 6 months for a semester. But he paid his tuition to the University of Notre Dame. And so in his particular case, he was able to get one of those education credits because he paid his tuition to a school that participated in the grant and loan program, even though he attended a semester in Rome. Okay, so let's go ahead and talk a little bit about income items. And so a lot of your taxpayers will be receiving Social Security benefits, and that'll be evidenced by an information return called an SSA 1099. And this is really important. A lot of people, you ask them, hey, how old do you have to be to receive Social Security benefits? And they'll say, oh, you got to be 65 or you got to be 66. Well, the general rule is what is called full retirement age. And I believe right now, I think it's at least 65, maybe a little bit, because I know it's changed over the years. But in a certain case, I met a guy who happened to be a federal employee, US government employee, and he retired when he was, I think, 56 or 57, and he promptly went on Social Security. So there are exceptions to that, kind of like the example I gave last week, where in California, if you want to be a licensed attorney, lawyer, the general rule is you're going to go to college, you're going to go to law school, and then you're going to pass the bar examination. Well, that's the general rule. Well, the exception in California is you don't need to go to college, you don't need to go to law school, but you do have to study under an attorney, and then you do have to take the bar examination. So that's an exception. And in the tax code and in the many different types of code books, you have certain exceptions. So when people say, yeah, you got to be 65 to be Social Security or of age, and thinking, no, you don't. That's the general rule, but there are exceptions. So you might have someone who is a little bit younger coming in and they're on Social Security. But anyway, they're going to get that document. And then what happens is there is an IRS publication that talks about Social Security in detail. And I know a lot of the AARP sites, they look at that publication 915. You also have what is called equivalent railroad retirement benefits. You see that from time to time. And so what that means is years ago, the railroad people, they set up their own retirement. They got the exception from the federal government. And so if you were a railroad employee, you will get the railroad retirement benefits, which are similar to Social Security. And here's another thing. You get these questions all the time. Well, why don't I get Social Security? And we ask them a few questions. Say, well, you didn't pay into the system or you weren't eligible. So like, for example, my boss at the IRS, I think she was 63 or 64 and she retired, and she'll never get Social Security. She doesn't work, she's retired. She paid into the federal retirement system and she is ineligible for Social Security. But for a lot of us, you can get Social Security if you pay into it, and you have to have 40 qualifying quarters. And so Pub 915 talks about that. And then this is something you will see from time to time. I saw this last year at one of my VITA sites where a taxpayer received lump sum payments. And what that means is you've applied for Social Security, you didn't get it the next month, maybe 2 or 3 years went by, and then finally you get this big lump sum payment. And what it is the payment says on your SSA 1099, a certain dollar amount is for this year, a certain dollar amount is for that year. And what happens is you have to get into the tab in the software and you have to indicate lump sum payment. So you follow the worksheet in the Pub 915, and you follow the information in the 4012 on page Delta 50. And so again, you're going to see that from time to time. And so that's those are your go-to documents to make sure that lump sum payments are taxed accordingly if they are set to tax. And then retirement income, you see a lot of this. Typically, you're going to have people who are usually 60 years or older, but sometimes you're going to have someone who's younger, and they're going to get that 1099-R maybe for a early distribution. There's a lot of young people in their 20s and 30s and 40s. They receive early distributions, and what they tell you, they go, "Well, I've already paid the tax." And I tell them, "Well, what happened is you took an early distribution, and there was federal tax withheld. And typically that federal tax is going to be 20%. And that may cover all of your tax liability. And if it doesn't, then of course you have to pay some additional tax. And then in addition to that, if you don't get that exception, there's a couple of exceptions, then you have to pay that penalty that we talked about, that 10% penalty. And then to the state of California, you also have to pay income tax on the distribution. And then you also have to pay a penalty of 2.5%. And so when you have someone who's 35 and they take out from their 401k, they take out like $50,000 and they spend it on whatever, it's usually about half, a little less than half in taxes and penalties. It's quite a surprise for someone who's never experienced that. And so what we do is we have to, of course, make sure we enter the 1099-R. And then, of course, so we have to answer the questions regarding whether or not their distribution is subject to a penalty. And you're going to see people who have IRAs, individual retirement arrangements, and they'll take a distribution. And for an IRA, a lot of those distributions are going to be a fully taxable event. But here's a however. Sometimes they did not take a deduction on their tax return. And so what that means is they don't have, let me restate that, they have what is called a taxable portion and a non-taxable portion. And it's really important. Sometimes you're going to ask for an IRS form 8606. And that's something I've asked for clients. So again, when someone receives a distribution from an IRA, individual retirement arrangement, it can be taxable in full, or it can be taxable in part. And you might want to get that IRS form 8606 to help you out. This is something, probably the best story I can think of. This goes back a few years ago. One of our preparers at the college I work at was helping out a pensioner and ended up completing the return. And this pensioner owed a truckload of money. And he was scratching his head. He couldn't understand it. So I went over there and I was looking at it and I said, do you have any basis or cost in your pension? Which means, did you make contributions to your pension? And here's something about pensions. If you're not used to pensions are like people. There's all different types of pensions, all different forms and shapes and colors, and they're not all the same. And so in his particular case, he had made contributions to his pension plan over many years. And so I said, okay, well, what that means is when you receive your pension payment, your annual payment, a portion of it is recovery of basis or cost, which is not taxed. And so what that means is we have to know how much you contributed to your pension. And so he says, well, I got to go home. I got to talk to the pension company, the trustee. And I said, all right, well, we'll see you later. So he came back a couple of weeks later, goes, Jerry, I figured it out. He gave me all the documents. I've got $80,000 basis in my pension. I said, okay, so what we're going to do then is for this tax year, we're going to go to the simplified method worksheet in the software. We're going to answer the questions regarding your particular pension and how much cost you have in your pension and how much you have recovered from your pension. Again, the recovery of the cost of the basis is not subject to taxation. So what that means is when you get a 1099-R and someone says, I've got cost in my pension, that means a portion of the pension payment will not be subject to taxation because it's a recovery of cost. I'll give you an example. You go to your bank, you open up a bank account, you put in $1,000 of your hard-earned money. And then the next week you drive by the bank and they've painted the bank a new color. Say, I don't like that color. You go into the manager and you say, I don't like the color of the bank. It distracts me. I want my $1,000 back. And the manager says, here's your $1,000. You now have a return of capital. There's no tax on that. You're simply getting your money back. Same thing with recovering cost or basis in your pension, you're getting money back. And so you want to keep in mind, you will see that from time to time, not very often, but when you see it, it's a big deal to the taxpayer. And if you see it and you're not quite sure, just go to one of the senior people at the sites. And if we identify, yes, there's basis or cost that has to be recovered, then we'll show you that simplified method worksheet again, and we'll populate the answers. And then the software will do the rest, i.e. determine the taxable and the non-taxable portion of the distribution. And again, this for some taxpayer, for this guy right here, my $80,000 basis story, this was significant. We calculated, I think, a $10,000 tax for this guy. And then once we got done, I think he owed like $1,000. So it's a big deal. And then we will show you the simplified method worksheet in the software and what you need to populate. So the qualified charitable distribution, I'm going to be really honest here. I've been aware of it. I haven't been aware of it for many years, but I've been aware of it. And quite frankly, I think I saw it one time a long time ago, and then recently I saw it again. So I don't think you're going to see it that often, but here's the thing about this. Someone has money in some type of plan, and they decide to donate monies to charity, which is a great thing. And so they issue an order to the trustee and they say, trustee, don't send me my distribution, send it directly to this particular charitable organization. If it's a qualified charitable organization, what that means is the taxpayer is not going to be able to take a deduction on their tax return for charity contribution, nor will they take on their tax return an item of income. And so you may see that from time to time. And if you do, that's described in page Delta 45 in your Pub 4012. And then keep in mind, when you're talking about qualified charitable organizations, we're going to get into that in detail here. It simply means an organization, an entity has established themselves. They've requested nonprofit status from the IRS, and they have to do certain things like educational things, cultural things, things for society. And once it's approved by the IRS, then of course, if you donate money, then you can take a deduction on your tax return. There are organizations out there, and I'm not saying they're bad, I'm just saying they're out there that are not qualified. And if you want to give your money to them, that's great, but you're not going to be able to take a tax deduction for contributions to a non-qualified charitable organization. And so I always get the question, Jerry, well, how can I find that out? Well, we're going to show you in a little bit, but I also tell people, these organizations have a tax ID number, and that tax ID number, they'll share it with you. Sometimes it's on the letter that they send you and they can thank you for the donation. And also you can find a qualified charitable organization by going to the IRS website, which we're going to show you shortly, and you can drill down and you can find it, all of the qualified organizations that have passed muster with the IRS. So that's all doable. Other types of income. One that you're going to see, it's called cancellation of debt. And the way I like to describe it is you have people who borrow money. And when you borrow money, there are no tax consequences. You can, if somebody wants to lend you money, you can borrow money all day long. But if you don't pay that borrowed money back, then what you may have what is called a cancellation of debt that's reported on your tax return. And a lot of people, that if you follow it mechanically, then you say, okay, I got it. And so what I tell people, when you borrow money, you have received what is called an economic benefit. You've got money that you didn't earn. Now, of course, you got to pay it back. And so you've got economic benefit, you've got economic enrichment. And then what happens is people have that benefit and they either are unwilling or they are unable to pay that debt back. And then at that point, there's a cancellation. What happens is taxpayers come into our VITA site with a information return called the 1099-C, and they go, hey, I got this from my credit card company. And then what we do, we ask them, okay, did you get this discharged in bankruptcy, federal bankruptcy court? No, I just got this 1099-C. What was your status before that cancellation? Were you insolvent, which means did you have more liabilities than you had assets? No, I'm good to go. I'm working. I have money in the bank. Okay, well then that's going to be a taxable event because again, you were economically enriched, didn't pay it back, and now you've got that cancellation. And so we will see that from time to time, but we do have to ask about bankruptcy. And we also have to ask about insolvency, which means more debt than assets. And then another thing that we see is called qualified principal residence indebtedness. This has been around for a while. This is something you probably want to have a senior preparer kind of tackle. But basically what it is someone has a house. This is their principal residence, and there is cancellation of some type of debt. Not everybody, but most people have some type of loan on their house. And some people can get some of that loan canceled, in some cases, all of it canceled. And if that's the case, then we have to attend to what is called residence indebtedness. It's written up in the publication 4012. And there's a great publication called the IRS publication 4681 that talks about not only cancellation of debt for personal residence, but also just cancellation of debt in general. And it's not a pleasant topic because a lot of people are embarrassed because they couldn't pay it back. But if they have it, and if we can help them, we will. All right, John, any questions about these topics?
Nope, I don't see any.
All right. Okay, a couple other things that we do see, and as I mentioned before, for some reason, we have a lot of people that like to enter prizes and award contests, or they win prizes and awards. And so what I always tell people when someone say, hey, I got this award, I won this award, I won this prize. And they always ask me, is it taxable? I'm thinking, well, it probably is. Of course, we'll ask the details. I use the term fact pattern because some things are really easy, like for example, you enter a contest at, let's say, McDonald's, the hamburger place, and they send you a letter to go, congratulations, you've won $10,000 and here's your check. Okay, that is clearly an award that is a taxable event. But sometimes you receive some type of award at your workplace, and depending on certain circumstances, it's not a taxable event. And so probably the best place to go in addition to your publication 4012 would be the IRS publication 525. But what I always tell people is, now we're not going to teach you to be IRS agents or professional tax preparers, but there is a code section which just about everybody knows in the tax world. It's section 61, and it simply says this. It says everything's included in gross income unless otherwise excluded. And so when people ask me, hey, is this taxable? I always say, well, let me look it up, but for now it's going to be taxable. And if I can find somewhere where it says it's not taxable, like for example, a loan, money that you borrow, it's not taxed. If you receive a gift, a bona fide gift, it's not going to be subject to taxation. If you receive an inheritance, let's say you receive a check for $10,000 from your grandfather, that's an example where it's not taxed. That's an exclusion. But you're going to see this, and a lot of the prizes and awards will be subject to income tax. And then we're going to just go to the other income tab and plug that into the software. And then sometimes, and I think this happened to me one time. I got a call and they go, hey, we got this award for you. We got this prize or whatever. I said, you know something, it's not worth my time to drive down to your place and pick it up. It's not big enough. So I don't want it. Give it to someone else. If you refuse a prize or if you refuse an award, it's not taxable. And then what will happen, not all the time, but prizes and awards will be evidenced by an information return called the 1099 MISC. And sometimes people will come and says, well, I don't have it, never got one, don't know where to get it, can't get it. So you ask them the information, say, okay, well, you've just described income, a prize or an award that is subject to taxation. So we're going to put it in the software, other income, and you'll be taxed on that. And then another thing you see a lot of is jury duty pay. And what happens is, and I think this is the case in most jurisdictions. I'm now, there's a lot of jurisdictions, but in most jurisdictions, when you report for jury duty and you participate on a jury, you're going to receive a very modest payment. It could be 10 or 15 or 20 bucks a day, something like that. And then when everything's all over, they're going to send you a check and say, thanks for your jury service. Here's your check. Well, step number one, you got to report that on your tax return, which we will show you in the software. And then I'll use me as an example again. So when I went on jury duty, I had to take my check and I had to give it to my IRS secretary. And I don't know where it went from there, but step number one, I had to report it because I received the check. And step number two, I took an adjustment to income if I gave it to my employer. And so you will see that from time to time. And if you don't give it to your employer, you don't have to give it to your employer, then you just go to step number one, you report it. And then another thing, and again, I think you see this in most jurisdictions, the court will provide a juror with some type of reimbursement. And if I remember correctly, in Orange County, I think it's one way to the courthouse. Well, that mileage check that they give you, that's reimbursement, which is not subject to taxation, which does not go on a tax return. All right. Any questions about prizes, awards, and jury pay? Has anybody ever been on a jury in here that wants to share their story?
Story about what? How much we earned?
Yeah, how
And what
much
we
you earned, and did you get a check? Did they stick it in your back pocket? Did they mail it to you? Did they drop it off on your car windshield? I mean, anybody want to share a story?
They just got it mailed to me,
Got it mailed
and
to
then
you.
and then
Did
and
they
then for the
also mail you?
reimbursement, the reimbursement
They mailed you?
reimbursement too.
Okay. Was it two separate checks, John, or one?
That I don't remember, but I think you mentioned right that only the pay that's taxable, not the reimbursement.
Okay. All right. So we do see that. We do see that. Okay. All right. And then if you're new, you want to jot this down. So what happens is
Hey,
there
Jerry?
are-
Jerry, somebody has a question. Anthony
Sure.
has a question.
Hi, I just wanted to ask a quick question. Can you guys hear me?
Yes.
Yes.
I was gonna say, like, I know we're coming near the holidays and some employers give gift cards. Like my dad, he always tells me every year they give him, like, every employer like a gift card, like a couple $100s. So I was just wondering, like, if you were to get like a $500 gift card, that's a good amount. Is that something that technically you have to report to the IRS?
Yeah, I heard the word employer.
Employer,
and I
yeah.
heard-
It sounds like
Yeah.
salary
So
wages. Yeah.
if your employer gives you a $100 gift card to some store, that's called compensation. And typically that compensation will be run through W-2 wages. If you have your friend that likes the way you smile and likes the color of your house and the color of your hair, and they go, hey, here's $100, here's a gift card, then that's what is called a bona fide gift. It's not reported.
And Jerry, this is Phil. Can you hear me?
Yes, Phil.
I just want to put a caveat on what you said. If somebody does give you a gift, you do not have to report that gift, but in certain cases, they may have to.
Oh, yeah, yeah. The
Just wanna make sure
donor,
people know.
yeah,
Yep.
the donor may be able to take in case of the employer, of course, they're going to take a deduction on their return for compensation they paid an employee. But yeah, just a bona fide gift, no, that's not going to be reported.
I'm talking
Oh.
about if it's over 17,000.
Oh, yeah. Oh, yeah. Thank
Gift
you.
tax,
Hey,
a
Phil,
gift tax, yeah.
I'll introduce Phil to the crowd here. So ladies and gentlemen, Phil, he's a great guy. He volunteers. He's also an attorney. He's a smart guy. And Phil, I think you work in Tustin, right?
I do.
Okay. So yeah, he's a great source of information. He's been doing taxes for a while. But yeah, when you're talking about a gift, so what that means is you may receive a gift from someone. Let's say you receive a gift for $25,000 from your mom, and your mom gives you the check for 25K. Well, your mother is going to have a requirement for what is called a gift tax return. You as the recipient, you can take the $25,000 and do whatever you want. It doesn't go on your return, but mom then would file a gift tax return. So yeah, but we don't do that in VITA. We'll tell them, hey, your mom may have an issue. She needs to go out and figure that out. But for you, you're good to go. All right. Okay, if you're new, you want to jot this down. This is not rocket science, but you just want to be aware of it. What happens is there are certain types of tax returns where you have either a partner or you have a shareholder or you have a beneficiary that they receive certain types of income from that entity. And so what we do in the VITA program, these are in scope. We will take care of it. It's called a Schedule K1. The 1065 is what is called a partnership return. And the 1120S is called an S corporation return. And the 1041 is called a return for estates and trust. Now, we don't prepare those types of returns in VITA, but someone may show up with a K1, and then what we'll do, we'll utilize that K1 and select certain items from the K1 and plug it into the software in the Form 1040 that we're preparing. And so you might have some interest income, some dividends, some capital gains and losses, or you might have royalty income. I actually had a student in one of my classes recently. I said, "Hey, what do you do for work?" Because we were all, talking about work. And she goes, "I write books." And thinking, "Oh, okay." I said, "Then you probably receive royalty income." She goes, "Yes, I do." And so that's an example where we've got these income items reported on these Schedule K1s from these entities that the tax bureau will give us the K1, and it will pluck off items from the K1 and enter it. So you do see that. And you will get these questions all the time. "Hey guys, why don't you do 1065s and why don't you do corporate returns?" And the answer is the tax world is a big, big world. And we have to focus on the 1040 because we have a very narrow charter. And something, there's enough issues in the 1040 to keep us busy. We just don't do certain returns. If someone wants a return completed that's outside the scope, they're going to have to go to a paid practitioner. So that's just the way it is. You will find the description that's shown on the screen here in your publication 4012. Okay, John, I'm going to go ahead and take let's take another 10-minute break before we jump into our Schedule A.
All right.
Okay, we're going to go ahead and get started again. And we're going to start off with the Schedule A, itemized deductions. And when you hear the term itemized deduction, it's simply a laundry list of items that Congress has provided for, where if you don't take the standard deduction, then you can take the itemized deduction. And the general rule is you're gonna deduct whichever is greater. And so when we talk about medical and dental expenses, it's written up in your Pub 4012, but these are the things that you want to kind of key in on. If you're driving to the hospital, if you're driving for some type of medical reasons, you're allowed a deduction for the miles that you drive. And for the first 6 months of the year in 2022, it's 18 cents a mile. And for the last 6 months, which would be from July 1st through December 31st, it's 22 cents a mile. And so the takeaway there is when someone says I got medical miles, you want to make sure you determine what months they've driven those miles in. And then I always use the term out-of-pocket medical. And so when you bump into someone who's paying their medical, it might be a deductible that they're paying, or maybe when they have a doctor's visit, they're paying out of cash, $20 or $30 for the visit, or they're buying prescription drugs and they've got some type of copay. And so all of that. And when you're paying insurance premiums, that also includes your Social Security payment, because a lot of people, not everybody, but a lot of people on Social Security, they're paying their Medicare premiums, and it's coming right out of their Social Security check. And I mentioned this before, to my knowledge, there's no statutory requirement that you have to go on Medicare. In fact, I know a guy, I think he's like 70 or 71. And I asked him, hey, are you on Medicare? He goes, nope, I'm not on Medicare. He does receive Social Security, but he's not on Medicare. So you're going to see that from time to time. But again, insurance premiums are considered out-of-pocket expenses. And typically you're going to have prescription drugs, you're going to have those copays, and then you have things like eyeglasses, hearing aids, maybe crutches, something like that. I've got a client who has nursing services. She's like 90, and so she has medical personnel visit her and attend to her as far as nursing services. I don't see a lot of guide dogs. Those are the people who typically they're visually impaired and they have a guide dog to help them out, but those are also deductible. And then things that
Jerry, on your premiums, right? If you have subsidized or it's insurance from your employer, you typically don't include that in your income. I don't think you can't take a deduction again for that.
No, if you're,
yeah,
like, for example, when I was an employee, I paid, I think 10% out of pocket. And then my employer paid 90%. But no, your insurance premiums, it has to be out of pocket. And so, for example, the Medicare is a great example. You're paying Medicare, it's coming out of your check, that's out of pocket. All right, and then things that are non-deductible, you see this all the time. People love to whiten their teeth. I guess that's great. You go to the dentist, and that's non-deductible. Maternity clothes, non-deductible. And then a lot of people have cosmetic treatment or surgery, and the general rule is that's not deductible. Now, you can find certain cases where there's an exception to that. Like I mentioned, there's always exceptions to the general rule, but generally when someone said, hey, I've got cosmetic surgery, I now have bigger biceps, or I've got a skinny tummy now that I have my tummy tuck, that's not going to be a deductible expense. For state and local taxes, this is something that you typically will see someone has state tax withheld from their check as an employee. They perhaps have made state estimated tax payments or they've paid into SDI. And so all of that would populate on the Schedule A as an alpha. And again, that would be for state taxes paid. And then you might be familiar with the argument going back a few years where Congress said, okay, we're going to limit the state and local taxes to $10,000. Typically in the VITA program, you don't see a lot of that, because if you have someone making $60K and they have $10,000 just in state and local taxes, that's almost 17% of their total income. So usually you don't see the 10,000 max. Now in my private practice, I see that all the time. And then you also have what is called a state tax deduction. That's something we're not going to talk about in detail right now, but you want to keep that in mind, because you can either take state taxes paid or your state sales tax. And so if you buy an automobile, big ticket item, you're going to pay a lot of state sales tax. And so you can have either or. And in your publication 4012, there's a description of the state sales tax deduction. And then real property tax, a lot of our folks that come to the site, a lot of them are older, meaning that they're in their 30s, 40s, 50s, 60s. They're not kids, and they pay property tax on their personal residence. So you will see that. You want to ask for the property tax bill. They typically have a copy of that. And then personal property tax, this is something usually your motor vehicles, i.e. your car, your motorcycle. And usually you're going to look at that Department of Motor Vehicle bill, and it's going to show the amount that is typically allowed for a tax deduction. And that term is called an ad valorem, which is Latin meaning according to value. And so you get that right off the DMV. And then a big one you're going to see in the VITA program is home mortgage interest. Some people have loans on their home, some people they don't. It just depends, but a lot of people do. And so what happens is they'll bring in the 1098, that information return, which has a lot of information on it. You're going to key in on interest received. I'm not going to discuss mortgage insurance premiums right now, but I will in either 3 or 4 sessions. But interest received is a big one, which means interest received by the mortgage company from the taxpayer. And then sometimes people pay points when they buy a house. That would be a fee they pay the lender. And the general rule is points are amortized. And amortized is a Latin term, which means to die or to kill off. So what that means is, and there's an example at the very bottom. Let's say you buy your house and you pay points of $3,000 and your loan is 30 years. That means you can amortize or take as a deduction $100 per year. And some people say, okay. And some people say, well, I don't want to do that. Then you can take the exception to the general rule where you can deduct your points in full. And we'll show you that in a little bit when we get to the software. And then a lot of our folks have reverse mortgages, and this is for your seniors, and I'm not trying to advocate for reverse mortgage. I don't know if they're good or bad. I guess for some people it's good and for some people it's bad. But this is what I do know. If you have one, it's considered a loan. And as I said before, you can borrow money all day long if people want to give you money, and there's no tax consequence to borrowing money. There's none. And so what happens is a reverse mortgage, it says at the bottom, it's interest accrued is considered interest on a home equity debt and not deductible. So you might see that from time to time. It simply means a check that the taxpayer gets on a regular basis. But again, it is in the form of a loan from the financial institution. And then at the very bottom of the screen, it talks about a refinance. And sometimes people will refinance their mortgage and they're paying points to refinance the mortgage. And so what they do, if they pay points to refinance, they have to spread the points over the life of the mortgage. And that would be obviously the second mortgage that they have. And of course, if they were using it to remodel, some people borrow money to doll up their house, fix up their house. And of course, it is not. All right, so that takes care of some of the Schedule A. Let's go ahead and unfreeze this and go back to our next discussion here. This document talks about charitable contributions. A lot of our times in the VITA program, it's cash being given by the taxpayer to usually St. Killian's or some other charitable organization. This publication does a really good job. There's another publication that talks about donating property, but this is the one that you're probably going to spend time with if you do any of your looking up or your research for charitable contributions. But typically it's pretty basic. Most people donate cash. And so this is the IRS URL that you would go to search for your nonprofit organization. And what nonprofits are required to do, they're required to maintain that status. They're required to file returns. And those returns that they file are posted on the IRS website. And again, nonprofits, cultural, educational, some type of social thing that's benefiting society as a whole. And so if you have any doubts about an organization that is either a tax exempt or a non-tax exempt, you can jump down, you can look into the system here in the IRS website. Now, what's important though, a lot of people will come to the site with a tax ID number from the organization. Like I've donated money over the years to nonprofits, and I'll get a letter and they'll say, Jerry, thanks for your donation. This is our organization. Here's our contact information. Here's our tax ID number. And I then looked them up, and sure enough, they're tax exempt. So, all right, a couple other things when you're talking about charitable contributions, most of our folks are going to give cash. If you're giving non-cash, then for the VITA program, there are limitations. You can give whatever you want as far as a donation, but in order for us to help you on your return as a VITA customer, your non-cash charitable contributions have to be $500 or less. And so what that means is there's a form 8283 in the software that populates. And this would be for people who are donating perhaps maybe an old refrigerator, an old couch, something like that, maybe some clothing, or maybe you've got what is called charitable miles. You're driving your vehicle like I've done in the past. I belong to a nonprofit and I do certain work for the nonprofit and they don't pay me. And then what I do is I drive all these miles and they still don't pay me for the miles. And I take the charitable contribution as in the form of miles, charitable miles on the tax return. And then when you're talking about cash gifts, you go back to the accounting definition of cash, which is basically Federal Reserve notes, coins, negotiable instruments. So if you make a Zelle payment to a charity, that's a cash gift. The rules have changed. In fact, your head probably spins around if you've been around the tax world. The old rules for many years, it was 50% of your AGI. Most of your VITA clients are not going to reach that. That's the maximum. If you give more, then of course it's a carry forward to the next year. Then the rule went up to 100% of AGI. And then in tax year 2022, they're going back to 60%. And that's per the Tax Cuts and Jobs Act of 2017. Again, we don't see this. I've only seen this, I think, one time, and that's for when I was working for the IRS. Some guy gave like 60 or 70% of his income to a temple. He was a Buddhist, and so he had what is called carry forward. But typically, we don't see this in VITA. And again, when you do charitable work, you have to remember that 14 cents is for the entire year for 2022. And a person says, I drove for the charity, they'll give you the mileage, you plug it into the software. And that includes paid parking and tolls.
Hey, Jerry, can
Okay,
you back
there's
up a second? There's just one question. It was in the chat about the $500 or less in non-cash. Is that for each charity or for overall?
That would be that'd be overall. Typically,
Okay.
like Salvation Army or maybe Goodwill, you donate some clothing, you donate maybe an old TV or something like that, old computer.
And I put my 14 cents a mile when I drive to VITA.
Yeah, if you're a VITA volunteer and you take your itemized deductions on a Schedule A,
Yep.
yes, you can go ahead and claim 14 cents because VITA is considered a charitable organization. Good point. Okay, deductions. We're not going to go through all of these, but typically you're going to have a cash donation, usually to a church. And of course, the definition of cash, just go to the financial accounting definition. Checks, usually cash, sometimes a direct debit from your account, but that would be cash. And a lot of people donate to a church or maybe to a nonprofit. United Way, Goodwill, those are typical. And there's other types of donations which are described in that publication. I threw in converting foreign currency. I donated money one time to the American Red Cross, to an American Red Cross agent. And I was in Belgium and she was in Belgium. And I just did the converting the foreign currency to put it in US dollars. I think we've seen this a couple times. And if you have someone who's donated something and it's in a currency other than US dollars, you just got to convert it. And probably the best way to do it is go to the US Treasury website and they have all the conversions. So the charitable contribution the deduction for a qualified charitable distribution, as shown on the bottom of the screen, you're not going to take any income from that distribution and you're not going to take a deduction. You're simply a nice person you're issuing an order to your trustee to make a payment directly to a charity. It doesn't pass through your hands. And if you want more on that, that publication 590B talks about qualified charitable distributions. I've seen that a couple times, but not a lot.
Yeah, Jared, I have one that I've done for the last couple of years, and it's kind of a big deal because it's the taxpayer has a substantial amount that's going through there. And if you made a mistake and put it in as income and then deducted it, it would increase their AGI, which starts to make their Social Security taxable. So it's, yeah, be careful on that one.
Yeah, you're
Yeah.
talking, the head bone's connected to the arm bone, which is
Yeah.
connected to the hip bone. And yeah, so when you make a change in your software, your tax preparation software, it will affect other things. You have phase outs, and
Yeah.
that's important. Here's another thing, and this is not the one-stop answer, but if you make a boo-boo on your return, you make a mistake, then what happens is one way to fix it, if you can fix it, would be an amended return. And I know we've done amended returns in the past. And Fred, if you're still on the line, maybe that's something we can do at our site, perhaps maybe toward the end of the season. Oops. And then real quick, non-deductible contributions. You see this all the time. People say, why can't I deduct that? And, I don't try to be flippant. I just say, well, the reason you can't deduct it is you're talking about the body of tax law, which is mostly the Internal Revenue Code. And there's certain things that you can't deduct. They're not allowed. And that's just the way it is. And so I give my example, my sister, she doesn't do this all the time, but on some Saturdays, she goes with her friends, and she's an older woman, and she buys a bunch of sandwiches, and then she goes to this one area in Los Angeles, and she hands them out to what we call homeless people. And they appreciate it, and they leave her alone. They don't hassle her. They take the food and eat it. And that's not a deductible item because she's not donating to a qualified charitable organization. And then you see other like social clubs. I belong to the Elks, and I pay dues, 150, 170 bucks a year, not deductible. Now, if I write a check for $2,000 to the National Elks Foundation, which is a charitable organization, that's a different story. And then I buy bingo tickets and raffle tickets, and they're not deductible. I've donated, actually, I've never donated blood, but if you donate blood, you're a great person, but you can't take a deduction. If you drive to the hospital or the Red Cross, then that's a medical, those are medical miles. You can take a deduction there. If you're donating plasma and you're selling it, then that means you've got income that you got to report as other income. And so those are the things that are not deductible. And just real quick, when you're talking about your medical miles, keep in mind your medical miles for the first half of the year, 18 cents a mile, and the last half of the year, 22 cents a mile. So again, you want your taxpayer to show you or to give you the amount for each half of the year, January through June 30th, and then July 1 through December 31st. Now, charitable contributions, it's 14 cents just for the whole year. Miscellaneous deductions, probably the key is gambling losses. What happens is if you have gambling winnings, you can take deductions on your Schedule A for those losses, and then certain expenses. And then when people say that they're a professional gambler, usually you should tell them that no, you're not. Professional gamblers, they know what they are. Most people you bump into who say they're professional, they're not professional, they're recreational gamblers. And if you're a recreational gambler, you've got to keep records of some kind. And then there are what are called impairment related work expenses. You have some type of mental or physical disability, and then you use certain type of equipment that you've paid for out of pocket, you can take some type of deduction. I'm going to run through this real quick because it is 11:30 and change, and we want to make sure we get to the software. So here's the takeaway for the publication 334. It has a number of chapters. There's a lot of information in here that does not pertain to VITA. But the takeaway here is if someone is self-employed, whether they're a locksmith, they're a daycare provider, they have a lawn business, whatever they do for self-employment, they want to have a working knowledge of this 334. It's going to help them out. And if in the VITA program, we only deal with cash method taxpayers, which means they're going to report their income when they receive it, and they're generally going to deduct their expenses when you pay them. And so again, it's important. Record keeping is also very important when it comes to taxes, because if you, in the unlikely event you go to an examination, either federal or state, well, part of that examination is they're looking at your records. If you have no records, then most likely you're going to see an adjustment, which means you're going to walk out of the office with the tax bill. That's really about it. Again, for brand new self-employed people, and I've met them a few times, they go, what's this self-employment tax? And I said, well, if you're self-employed and you have over $400 of what is called net income, then under the Self-Employment Contributions Act, SECA, you got to pay self-employment tax, which is approximately 15% of your net income. And that is in addition to individual income tax. And so for some of our folks, it's a lot of tax that they're paying. But keep in mind, if you pay into Social Security via self-employment tax, you may have a qualifying quarter. If you've got 40 qualifying quarters, then you're eligible for Social Security. I'm not going to go through this, but we are going to talk about material participation in a very basic way. But when you hear that term material participation, this is what you need to remember. You need to remember that you're involved in your business, talking about like a self-employed individual, on an ongoing and regular basis. And that's really the definition of material participation. I'm going to show you, if you don't have to memorize this, there's a Treasury regulation that talks about all of this. But what this describes on this screen is regular and ongoing participation. And I'll tell you the importance of material participation in just a little bit. Okay, Schedule C is for self-employed individuals, and some people call it an income statement. Some people call it a profit and loss statement. Some people call it an operating statement. What it all means is you're going to report your income and you're going to report your expenses, and then the difference will be either a net income or net loss. And when you talk about part one on the Schedule C, you have gross receipts, there's gross profit, gross income, and you're going to see that when we go through the software. Here's a big one. We see it in VITA all the time. People will come up and they go, I got this expense and I got that expense. And so here are the rules that we follow. If you have expenses for your Schedule C for self-employment, they have to be ordinary and necessary. There has to be a business purpose, and it has to be reasonable. And so I'll use an example. I had a locksmith come over some time ago, and he fixed the lock on my front door. I said, all right, thanks. And I said, how much? Oh, yeah, I had to give him a whole bunch of money. And then I said, hey, tell me about your business. So he told me about his business, and we were talking about the types of expenses a locksmith would incur. Driving to my house to fix my lock, some of the spare parts that he uses, things like that. So yeah, those are things. The reasonable test, probably the best example I can give is, let's say you're a graphic artist, and or maybe you're in some type of business and you have someone design a flyer for you. And that someone happens to be your 11-year-old brother. And the flyer took him 15 minutes to put together. And he goes, here's your flyer. How much? $9,000. Well, that is an unreasonable amount to pay an 11-year-old kid for 15 minutes of work of designing a flyer. I don't know what the right amount is, but it's not 9,000. It might be 100, it might be 150. And so that's something that you would, you're not an auditor in the VITA program, but you certainly would ask those questions, because in that case, that could be a situation where you are essentially moving some type of expense, or moving an income to someone else, i.e. your kid brother. Other things we see in the VITA program: transportation and travel, again, all business related. Education, this would not be for your college. This is if you, let's say you're a tax professional, for example, you have certain types of education you have to attend to maintain your credentials, to maintain your competency. And so that would be an example of education. Sometimes you hear about special clothing. Again, you're looking at something not adapted to general streetwear. I always use the example, you're self-employed and you're advertising for restaurants, and you dress up in a chicken costume that you bought. So you're a big chicken and you're standing there with your big billboard, buy this food at this restaurant. That would be special clothing. Gifts, You don't see that very often, but there's a limitation. You're giving money, you're giving gifts, I should say, to your customers, obviously to keep their business. Bad debt, you don't see this in the VITA program because we're cash method. Cash method taxpayers are not going to have a bad debt. And this is something we don't do in VITA unless you certify on a military certification test. And in that case, we will address depreciation, but only take the amount given to us by the taxpayer. But at St. Killian's, we don't deal with depreciation, depletion, and amortization. We can give the definition. It's called cost recovery. We don't do it in VITA. They have to go to a paid professional. And then at the very end, substantiation. This is something they want to maintain in the unlikely event that they're audited. And then keep in mind when you're talking about the very top, if you're incurring personal and family living expenses, well, the general rule is they're not deductible. So if you buy a hamburger for lunch, the general rule is that's not deductible. And there are exceptions to that if you're in a travel status. This is a really detailed explanation, but I'm just going to kind of sum it up. I've done the research, and here's the bottom line. The recent court cases that have come out, if you have a cellular telephone, and they're called different things, but I'll call it a cellular telephone, and your bill is not itemized. Like, for example, I have a cell phone. I got one cell phone. My bill is not itemized. I pay like 50 or 60 bucks a month. I guess I could get an itemized bill and I could determine what my business calls were, but I don't. And that means I cannot deduct my cell phone, even though I'm a tax practitioner and I use my one cell phone for my tax practice. But I also use it for the classes I teach. I also use it for my personal life, and I don't get that itemized list. So the vast majority of your people say, I've got a cell phone and I use it for my business. If they don't get that itemized list, they're not going to be able to take it as a deduction. And at the site, I'm not going to give them the deduction. I would tell them, you're not allowed. And if they want to get into a discussion, I'll be happy to get into a discussion. I'll be happy to bring up the court cases for them. But the bottom line is the vast majority of our clients are not going to be able to take that deduction.
Sure. What do you mean by itemized list? If your phone bill has every call listed and what the number is, you could presumably determine which one's in.
Let's say you pay 50 bucks a month like I do, and then you get that itemized list from your carrier, and then you can identify 10% of your calls were business calls. And so at that point, then it's reasonable. You can take 10% of that $50, which would be $5 per month as a business expense for your cellular phone.
Yeah. Or do it by minutes instead of calls. I guess you could a million ways you could do it, right?
Some methodology, yeah.
Now,
I mean, I bumped into people all the time. They go, hey, I've got to have a cell phone. And I look them in the eyeball and say, you know something? I'm a tax practitioner. I charge money for tax returns. And I use my cell phone all the time. I got people calling me all the time, and I don't deduct a penny on my return. And so how can you deduct it on your return? You just
now,
can't.
if you're an Uber driver and you need that phone for navigation,
If you have one cellular phone and you can get some type of itemized list from your carrier, that is an excellent point, but you're going to have a methodology to allocate between personal and business. And that's what the courts have said.
the data plan would figure out
Yeah,
what percentage your data plan was for mileage or for navigation. But
and I don't think you have to be a mathematician or a physicist to figure this out. Just say, hey, if you want to take a deduction, and I think that was Scott, then just go to your carrier and say, hey, I need an itemized list. And then they would come to the VITA site and say, okay, I've gone through the methodology and 25% of my phone is dedicated to business and 75% to personal. Okay, then fine, we'll do the allocation because you've got some type of itemized list. That makes sense. Okay, we're not going to spend a lot of time on this. We don't do cost of goods sold. That would be a retailer where you're buying something, you're reselling. We don't do it. And if people say, please, we say, we're not trying to do it. You need to go to a paid practitioner. Car stuff, you'll see this all the time where people are in some type of line of work, self-employed. So you want to keep in mind in the VITA program, we only do standard mileage rate. We do not do actual. That's outside of the scope. So for standard mileage, you're basically looking at, you're splitting the year up in 2022, 58.5 cents for the first 6 months, 62.5 cents. So they got a logbook, some type of document, they've written this down, they track their miles. And in addition to that, paid business parking and paid business tolls, they can take that. And that's typically what you see. There's a few other things about car interest and personal property tax. We'll talk about that later, probably in session 3 or 4, and then we'll gear it down to the publication 4012. Other expenses, this is important. You have many different lines of work, and people are going to have different types of expenses. If you can't find a place on the Schedule C, then you go to the itemized list, you populate the software with the name, the nomenclature of the expense, and then the dollar amount. Office in the home, we don't do it in VITA, and people will say, well, I've got one. And we should say, well, we can't do that. So you have to go to a paid practitioner. Let's see, I think that's all we want to talk about there. Self-employment tax, most people know about it. New people to the self-employment world, they find out about it and they realize, okay, yeah, I got to pay this tax, which again, if they have qualifying quarters, it helps to build that so they can eventually be eligible for Social Security. If you've ever talked to someone in their late 50s or early 60s who has not qualified for Social Security, and they're just a couple quarters away, you can sense the desperation and the frustration. And I've met people like that. And so when you bump into them, you say, look, there's a couple of ways you can qualify. Find work and get your qualifying quarters, because Social Security is an all or nothing proposition. You got to have 40 quarters. And then quite frankly, I can't remember, this is for my paid stuff, but sometimes you have two different types of businesses. And the rule is we go right back to the accounting. You have to match expenses to income. So sometimes you have multiple Schedule Cs. I don't know if I've seen that in VITA, but anyway, that's the rule. Okay, grab your pencils. We're going to do a quick Schedule C computation, and I'm going to run you through it. This is a tax practitioner who's decided this is their last year, and they've come to the VITA site, and they're not going to do their return, and this is what they have. They have gross receipts. They're a cash method taxpayer, by the way. Gross receipts of $40,000. They have billed some of their clients, and their clients have not paid them to the tune of $2,500. That's called accounts receivable. And it's kind of like me. I do some work for clients, non-VITA clients, and it's free work for various reasons. They're usually very low income and they don't want to go to VITA, and that's called pro bono work. And I assess $1,000 of work-related income, but again, it's not received, and that's why they call it pro bono work, and you assign a dollar amount to it. So for the purposes of VITA, you're looking at cash receipts on a self-employed business person. And so there's our income information. Here's our expenses, and I'll run through this. This is for a tax practitioner that you're helping out. Software, that's an ordinary necessary expense. Supplies, ordinary and necessary. Continuing education, ordinary and necessary. Professional pubs, ordinary and necessary. A mailbox, this could be a drop box, ordinary and necessary. This guy or gal, they want to go to the gymnasium on a regular basis, and they want to stay mentally and physically alert. And remember that thing we had on that previous slide where it says you cannot deduct your personal and family living expenses. This person drinks coffee and goes to Starbucks or wherever and gets their daily coffee. They cannot deduct their personal and living expenses. This individual has one cell phone and does not get an itemized list. And so that's the information on that. They have business miles, and the first half of the year, they drove 2,000 miles. And the second half of the year, they drove 1,000 miles. So keep in mind, the first half of the year for business miles, it's 58.5 cents. For the second half, it's 62.5 cents. And then they have business tolls, i.e. they're driving their vehicle and they're paying their tolls to use the road, 150. So take a couple minutes and see if you can determine net income. Net income is defined as income less ordinary and necessary expenses. And if you have a question, please shout it out. And John, can you ask one of our participants to volunteer to give us an answer?
I don't know who wants to take a shot at this.
See if we can get one of our new participants to offer an answer.
I'd take a shot at it.
Oh, good. I don't want to put anybody on the spot, so go for it.
Okay, and who's that?
Bob Rosen.
Okay, hi Bob. Yeah, what'd you come up with?
I came up with 37,070. It's not exact because I didn't remember the exact amounts for the business mileage, but that's what I come up with is in the ballpark.
Okay, so let's run through this, and if we can. So Bob, what'd you get for gross receipts, or what we call total income?
That would be 43,500.
Okay, and so accounts receivable, if you're a cash method taxpayer, you only report what you receive, and so accounts receivable would not be included. And then that
Okay.
value that you assigned to the pro bono work would not be included. So we're left with the 40,000.
All right.
And so if you take your, can you recalculate and tell me what you come up with now?
All right. I'd be, let's see. I'd be subtracting. No, adding 3,500.
Subtracting 3,500 from what you originally had.
What I had, yeah. But now I got 33,570.
Okay, we're close.
You know,
I had a different figure. So
I have a
so-
number that's similar, that's close. Can I go through it?
shout it out.
33,555.
That's what I got. So let's run through it and let's see if we can get some agreement. So I came up with 40,000 for a cash method taxpayer for gross receipts. And then here are the income items that are allowed. The tax prep of 2,000, meaning the software, the supplies of 1,500, continuing ed 500, the pubs 300, the mailbox 200. The gym membership is not deducted. That is a personal expense which is not deducted. The daily coffee, not deducted. That's a personal expense. The cell phone, not deducted because we have no information regarding an itemized list. And then business miles, this is what I came up with. 2,000 business miles for the first half of the year. You would multiply that by 58.5 cents a mile. And I came up with a total of $1,170. And then the last half of the year, it's 1,000 miles at 62.5 cents a mile. And I came up at 625. And then business tolls are added. So total expenses that I came up with, 6,445. And then that gave us a net income of 33,555. And did anybody else get that?
Yeah,
Okay.
Yeah, I did.
Yes.
Scott? And
Yep.
okay.
I
So
got
that's
it.
how you would do it. And keep in mind, ladies and gentlemen, this is going to be really easy when you open up that software because you're going to populate it. And you may think you're a genius, and the software, guess what, is usually going to be much smarter than you. So that's a good thing. So if you make a mistake, if you're entering the correct data, then it's going to calculate net income, which is a good thing. Okay, so that's our answer, 33,550. Okay, let's go ahead and jump through the rest of this because I want to spend some time with the software here. And if you're brand new, you want to grab your pencils. We're going to talk about a couple of concepts here. So this is a summary. So again, when you're talking about a Schedule C, we're talking about a cash method taxpayer. If they're accrual method, typically you won't see that. They have to go to a paid practitioner. If they have cost of goods sold, inventory, we don't attend to that in the VITA program. That material participation, that long list that I had there, there's a regulation that explains the same thing. If you materially participate, that means you ran your business, you did the work, it's an ongoing type of thing. And it also means if you have losses, which we don't see in VITA, you can take those losses. Sometimes you have a qualified joint venture, which simply means you've got a mom and pop Schedule C, and if they're both participating in a equal, then what happens is you indicate that in the software. 2 Schedule Cs are generated. The income and the expenses are split in half, and that means both taxpayers have a Schedule C, and both taxpayers pay into Social Security through self-employment tax. We talked about the deductions, and what I mentioned is ordinary, necessary, business purpose, and reasonable. And if you look at that, you're going to be able to explain this to clients and say, this is when you can deduct something. And we already talked about the cell phone. And again, if someone comes to me and says, Jerry, I need it for my business, like I said before, I'll hold my cell phone up and say, I'm a businessman. In fact, I've got 2 businesses, and I use my cell phone, and I don't take a penny in deduction. I don't. Internet, your basic internet service, you're going to see that from time to time, and that's also a business. Excuse me, that's also a personal expense. Could you go through an allocation? You could, but typically it's a personal expense. And then we do not attend to people who have employees if they're self-employed. We don't do that stuff in VITA, and we do not calculate depreciation. We've already talked about the vehicle expense. That's also described in Pub 463. And the rates, like we talked about, it depends on the first or the second half of the year. And here's something that you will see from time to time. I've actually seen it a lot more in VITA. Estimated tax payments, people who have a tax liability at the end of the year, and they go, how do I take care of this? Well, yeah, you're supposed to make estimated tax payments known as quarterly payments. So you want to attend to that next year. But some people have already made those payments. And so you get that information, you'll enter it into the software. QBI for our discussion, this is something that came out of the Tax Cuts and Jobs Act of 2017. It's 20%. And if it pops up on the return, it's a great deduction for the taxpayer. And you'll see that for mostly self-employed folks.
Jerry, for the estimated tax payments, it's not necessarily people with Schedule Cs, right? You could just have.
Yeah, I mean, I'm a wage earner. 1 year, I was
Yeah.
very fortunate. I had many sources of income. Life was great.
Yeah.
I mean, life is still good. And I had to go and make estimated tax payments as a wage earner. Yeah. Because the general rule is you're going to pay 90% of your tax during the year. That's the general rule. Okay. This is a laundry list. You don't have to memorize it. We're talking about the sale of a residence, but when you're talking about the sale of a residence, it can be a real basic computation, or it can be a very involved one. And quite frankly, if you start tackling a tax return or a tax issue, and you realize, wait a second, this is just taking way too much time. I've got to do research. Well, maybe you want to hand it over to someone else. I mean, I know there's a couple, 3 or 4 people on the call here who are tax professionals, and I have wrestled with tax issues. I had one that was a monster that took me 30 clock hours to work out for a client, one tax issue. And I did significant research. Now in the VITA program, we don't do that. It's basically, we got the answer in the publication 4012. But you can see when you talk about selling a home, there's a lot of things that you can look at. So let's look at a couple things with the sale of a home, and you kind of make it basic for us. If you sell your home, it's great to look at the IRS Pub 423. When you sell your home is a capital asset, and you're going to be issued a 1099 S as in Sierra by the escrow company. Typically, most people are going to go through escrow, but I do know sometimes you have a private sale, but usually it's escrow. And capital assets, then when you sell them, you're going to report them, and it'll end up on the 8949 and roll over to the Schedule D as in Delta. And then you've got long and short term. If you're brand new, short term disposition, which means you held that capital asset, i.e. your personal residence, for 1 year or less. If you hold it for over a year, that's called a long term, which means you're going to get preferential tax treatment as far as the tax rate. And the software does it for us automatically. Here's the takeaway here. The 1099-S is going to be issued to the person who sold their home. And then you want to report the sale of the home, even though you may not have any tax. That's the takeaway. And then moving on. And so this is the calculation that your software is going to do. And of course, you've got to make some entries. So you've got a selling price. The selling price will be on the settlement statement. You got selling expenses. Typically, it's going to be your real estate commission. And then once you subtract those, then you end up with what is called the amount realized. And amount realized, then you would subtract what is called your cost or your adjusted basis, which is the cost of your house plus your adjustments. Adjustments could be you put in a swimming pool where a swimming pool didn't exist, or you had a dirt driveway and you laid concrete to the tune of $10,000. Those would be adjustments, which are all added up into the term called adjusted basis. So you take your amount realized, subtract adjusted basis, you end up with what you call a gain or a loss. And then if you're entitled to an exclusion, and that maximum exclusion is $500,000 for a married couple, then you end up with the amount recognized. And when you hear the term amount recognized, that means that's what's reported on a tax return as a taxable event. So that's the formula. And the entries in some cases are pretty basic. So you start off with the 1099-S. Usually you're going to get it from the escrow company. It's going to have a lot of information, and the big item will be gross proceeds. Not your check, not your check. Let's see, here's your selling expenses. Typically, it's going to be your real estate fees. And it depends. I've seen real estate fees at 0.5%, and I've seen real estate fees at 7%. So it depends on where you are in the world. But again, most people will pay a commission to an agent to sell it. And then there are other fees that you can add to selling expenses. And that publication 523 does a really good job. This is an example of a settlement statement. They all look a little different, but the bottom line is when someone comes to me and says, "Hey, Jerry, I sold my home," I said, "Okay. And so what we need to do, we need to calculate the gain or the loss. The loss is not deductible on your principal residence. And we want to take advantage of that exclusion if we can." So I asked them for the settlement statement when we bought the house and a settlement statement when they sold the house. I had a client last year. She's 90 years old and she sold her home. She owned it for like 54 years. I said, "Do you have that original settlement statement?" She goes, "Yeah, I do." It looked a little bit different than what it shows on the screen here, but she had one. And then she had a laundry list of all of her capital expenditures for 54 years. And she knew the difference between a repair and a capital expenditure. And so we added all those up. I looked at her settlement statement when she sold the property, and we were able to, in short order, to determine the amount of her gain. And this gets involved, but when you talk about basis, or what we call adjusted basis, what you want to remember, you're typically looking at your cost of the home. You're looking at capital improvements, a new swimming pool that you don't have, or a new driveway that you did not have. And then what are called non-recurring closing costs, or certain closing costs that you can add to that total called adjusted basis. You can basically just, if you have the PowerPoint, you can look at this. This is a laundry list of what goes into basis adjustments. This gets involved. All right, so let's do the exclusion. Again, you're going to calculate the gain based on that formula you went through. And then if you meet the rules for the exclusion, it's either 250K or 500K if you're filing a joint return. And then you have to meet what we call eligibility test. This is something you see from time to time, and you just got to tell them, "I'm sorry, we can't help you." It's called a partial exclusion. They've owned the home for a year and then they move because they had to move for whatever reason. You say, "We don't do that." That partial exclusion is something you have to go to a paid practitioner. Here are the various steps. And what I want to do, I want to kind of key in on just a couple of them. It's called the ownership and use test, the ownership and use. And so you own the home for the last 2 years, or last 2 years out of the last 5 years before you sell it. And then you've used the home for 2 years. And that use does not have to be consecutive. You can use it for a little bit, move out, move back in. But you want to go through these rules with your VITA client to determine if they get this exclusion. And again, this exclusion is $500,000 for married folks. So you simply want to get it right. And that's why a detailed interview, And sometimes in Hollywood, they call it, you got to storyboard it. I have literally taken out a perpetual calendar, either electronic or hard copy, and say, okay, let's go through the dates here to determine if you've met the rule of owning your house and living in your house for this period of time. And I think that's all we need to look at there. Okay, so the bottom line is if they get a 1099-S, they're going to have to report the sale, even though they have no taxable gain. If they have a loss in the sale of their home, which does happen, non-deductible loss on your personal residence. And again, this is an example. There's the formula in the upper left-hand corner. You've got your selling expense less your, your selling price less your selling expenses, which equals amount realized. You subtract your adjusted basis, i.e. your cost, you end up with gain or loss. You take the exclusion if you're entitled to it, and then you have the amount recognized, which is reported on your tax return and then taxed at either short-term rates or, if you've owned the property over a year, long-term capital gains rate, which is preferential, which is lower than ordinary rates. And so that's how it would work.
I was about to say, I didn't want to cut you. Did we skip a break?
No, we're about ready to take one.
Okay.
So again, this is the formula, and this will all spell out in your software. For some people, it's a little bit involved, and for most, it's pretty basic. Record keeping is a big thing. Some people say, well, I did this and I did that. And you'll ask them, well, do you have the dollar amount? Well, no, I don't. Well, maybe you should sit in the corner and think about it. Or maybe you can go home and look at your records, because if you have capital expenditures that you've made, it's going to reduce your amount recognized at the end of the day. And I've never met anybody in my life who wants to pay more income tax. So anyway, that's what you do. You get the records and you're able to calculate the amount recognized. And John, this is a good time. It's 12:13. Let's go ahead and take a 10-minute, come back at 12:24.
Okay. There was one question from Jennifer
Sure.
McGuire. And Jennifer, I'm sorry, I don't remember what this was referring to.
Hey guys, sorry. I was too excited about the break and stepped away.
Okay.
It's been answered in the session. We were going through, hey, what's the aggregate of adjustments to basis? And Jerry provided that the client would, aggregate that themselves and provide us a dollar amount. We don't have to, document it in a spreadsheet or put it together for them. They'll provide us a substantiation.
No.
Yep.
No, you get the total. And then sometimes you'll go through it and say, well, wait a second, you repaired 5 broken windows when you owned your house. That is not a capital improvement. That does not go into adjusted basis. That's a repair non-deductible. It doesn't go into the calculation.
But say they gave us a lump sum, would you start interviewing them or just take it on faith?
Well, the way I would look at it is if someone gives me a lump sum, then I would kind of review the very basic rules. And if they nod their head and say, yeah, that's it, I would say, okay, then we're going to take this as your adjusted basis. But yeah, it's always good to educate your VITA client. And some of them are really sharp, and others, they're going to look at you like, what are you talking about? And that's when you're going to explain the difference between a repair and a capital expenditure. All right, back
All right.
a little
Thanks,
bit.
Jerry.
Okay, let's run through the rest of the PowerPoint and then jump into our software. So this is a form that individuals who sell their principal residence will get from their escrow company. And this is something that you may take a look at. Probably the takeaway here is if they've got some type of state tax withheld, then of course that would be reflected on their state tax return. So sometimes you will see state tax withheld from the sale of a principal residence. Let me unfreeze my screen. For the sale of a capital asset in the VITA program, we typically will see individuals with the sale of stock. They're a shareholder in a corporation. Sometimes maybe they sold some bonds, but typically stock or maybe some mutual fund shares, which are defined as capital assets. And so when you sell a capital asset, you're going to either have a gain or a loss. And for cryptocurrency, we simply do not calculate the gain or loss in the sale of cryptocurrency. That is outside of the scope of VITA. They're going to have to go somewhere else. And as far as the disposition of a capital asset, your software is going to calculate the short term or the long term because you're going to enter dates. And then sometimes you're going to end up with what is called the cost. You have to determine costs and of course the sales, the proceeds. Well, sometimes your cost is adjusted, and that's why you have what is called adjusted basis. So that's an example where you buy a motorcycle, a personal motorcycle, which is capital asset. You buy it for $20K and you install some pipes on it. And now your adjusted basis is $25,000. So if you sold your motorcycle for $30,000, 30 less 25 would be a $5,000 gain, which is reported on your tax return. If you sell your personal motorcycle at a loss, you cannot take the loss on your tax return. And then here's the big one down here toward the bottom. Your taxpayers are typically going to receive an IRS form 1099-B, and this is from the broker, and this is an information return. And as I said before, I think last week, 1099-Bs, they're all different. They typically have all the same information you need on it, and typically it'll be the information that you can use to prepare a return. Sometimes a 1099-B is going to be very difficult to understand. I've called brokerage houses and I've told them, look, I think I'm fairly well educated. I know a little bit about tax. I don't understand your 1099-B. And they'll get someone and say, oh yeah, we're trying to change it, but right now this is what it says. Typically your 1099-B will have the information that you need. And then you do see a term called a capital loss carry forward. So you're only allowed to deduct a certain amount. Your software is going to do that. The rest then goes forward to the next tax year.
That's one reason why you need to, that's one reason why you need to see the prior year's return.
Absolutely. Yeah, absolutely. We ask for the prior year return. Why do you need that? Because there's a lot of things on your prior year that may have consequences for the current year. You may have a capital loss carry forward from a previous year that we need to enter on the current year. So you want to get that both federal and state. Capital gains distribution. This is when you are a mutual fund shareholder, and the mutual fund, of course, they buy shares in corporations, and then you have dispositions of capital assets. And what happens at the end of the day, you've got that flow through down to you. That's called a capital gains distribution, typically reflected on a 1099 DIV. And all 1099 DIVs are not alike. Sometimes you're going to look at a document and you're going to say, wait a second, this is a 1099 DIV. And other times you look at a document and it'll clearly state at the top in large bold font, 1099 DIV. Don't get frustrated, just review the document. And if you have questions of the taxpayer, ask them, because you're going to see some different stuff in the VITA program. Okay, we talked about the sale. These are additional things. Probably the takeaway here is your educator expense. This is an adjustment to income. It's gone up to $300 in tax year 2022. Your one half your one half SE tax deduction, that's going to appear automatically. A lot of people have student loans and they pay interest on the student loans, but there's a maximum deduction adjustment to income is $2,500. The IRA deduction, this is a big one, especially for low and moderate income taxpayers. They can make a contribution to an IRA and they can take a deduction in most cases on their individual return, which is a good thing for them. And we talked about jury duty. Jury duty, step number one, you report it. Step number two, you take an adjustment to income if you've given that pay to your employer, i.e. turned over the check. Let's jump into our software here. So give me a moment to get set up. And let's see if we can describe a little bit about our taxpayers here. And then John, can you keep me honest? Can you see the software?
Yeah, I can see it.
See if I can log in here. All right, strike one, as they say. Let me try that again. All right, John, give me a second here.
This says 22. Were you trying to log into 21?
You can log in either way, but there's a whole
Okay.
bunch of ways to do it. So we're going to do it. We're going to do it according to Jerry. We're going to do Jerry's way for the second time. All right. So give me a second here. I'll be bouncing around here. Give me a second. Okay, John, can you see the IRS website?
Yes.
All right, cool. Okay, for the brand new folks, like I say, there's a bunch of ways to do it, but you're looking for a link and learn. You can save it on your desktop. And like I said, there are many ways to do it, but at the end of the day, you're going to go to link and learn. And you're going to open up the practice lab.
Actually, Jerry, now you're looking at, now I'm just seeing the login to ProWeb page.
You can't see, can you see the practice lab now?
No, it just says,
No,
Stand by. What's that one saying? If there's a will, there's a way. All right, how about now?
oh, yeah.
yes, yep.
Wonderful. Okay, once again, the secret password is train pro web, all one word, all uppercase, train pro web. And then let me go ahead and log in now. Back to our big blue tab, go to practice area. And then I've already entered this information into the software. So we're going to walk through it. And this would be for our taxpayer, the wins. And let's see if this pops up. Okay, this would be for David Wynn. We're going to go in there. And you can see in the upper left-hand corner, this is for tax year 2022. At current, the software that's been posted to the Link and Learn website, it doesn't have the state of California. And so we're going to work with our federal return. The state of California should be posted by the next time we meet. If not, we're going to go and utilize the 2021 software where it does have California. Here's our basic information. So just a couple of points. I'll navigate slow so you can kind of take notes if you need to. Your filing status. Again, there's a decision tree if you need to determine that. Our taxpayers are joint filers. There is a wizard if you want to use that. I'd recommend either the decision tree in your Pub 4012 or the wizard. Here's all that information that we entered for the taxpayer. He's the locksmith, inspired by the guy that fixed my front door for many, many dollars. In this case, he wants $3 to go to the presidential election campaign, and he wants written communications sent to him in the Vietnamese language. And once again, the intake and interview sheet comes in about 23 different languages. One is Vietnamese. Okay, this is the spouse, and we've entered the date of birth, and she too wants monies to go to the election campaign. Won't affect their return or the amount that they owe. And again, we only use California returns for our VITA program. Okay, we're going to continue, and we're going to go to, in this case, they've got no dependents, and we're going to hit continue and jump over to our income section. Over on the left-hand side, you have your income section at the very top. We're going to open up the W-2. In this case, we've got one W-2, and this would be for the taxpayer wife, Ali. So we've entered the W-2. We've got our EIN. The rule is we key it as we see it from the W-2. You might have a headquarters of a corporation in another state, and the employee is working and living in California, and that means there'll be tax withheld from the employer and then remitted to the state of California. Okay, in this case, she's got wages of $28,000. She's got some withholding. Box 3, 4, and 5, and 6, they auto-populated based on the FICA and the Medicare rate. She has deferred compensation. Actually, let's change that to, how about insurance of $3,000. DD is insurance, and that would be the insurance premiums paid by the employer on behalf of the employee. And then we mentioned California State Disability Insurance. Not everybody pays into it. When I was an IRS employee, I never paid a penny into it for 27 years. So there are some people who do not pay into it, but a lot of people do. And then this amount will roll over to the Schedule A as an alpha for itemized deductions because it is a tax. And then down here, this is the California information. Typically, your wages will be the same as box 1, your state wages and federal wages. And this, of course, is your state tax withheld. Okay, we're done with the W-2. Then we're going to bounce over to the Schedule C, which is for self-employment. And we come down here and we see the Schedule C as in Charlie, and we open that up. You can see the dashboard. This dashboard is going to be helpful to you as a VITA volunteer. It shows total income and then those ordinary necessary expenses and then the net income. So we know right now this individual is going to pay self-employment tax at a minimum. So we're going to open this up and take a look at it. We've got basic information. And a lot of times you're going to have someone involved in some self-employment and they're not going to be operating under a DBA, doing business as. If they are, then we'll enter that data. Some will not have an EIN, they'll just use their social, and a lot of times you're just going to leave this blank. Your business codes are going to be found, it's a laundry list, and so what happens, you open up that business code and you select the one that closely resembles the type of business. In this case, I ended up with this business code. All right, and we're going to go to questions about the business and see if we need to address any of that. Anybody in the VITA program that we work with, they're going to have to be cash. We don't work with accrual taxpayers. We don't deal with inventory, so you can just leave this alone. We're not going to change that. And then material participation, you might remember that discussion we had, ongoing and regular involvement. So we'll just check that and leave that as it is. If you have a mom and pop and they're operating 50-50 and you want 2 Schedule Cs and you want to split the income and expenses, you would check here. This is not a partnership. If you know anything about partnership returns, this is not a partnership. A partnership would go on a form 1065, and we do not prepare 1065s. And then really going to spend time in two tabs, your general expenses and your vehicle expense. And so we've got general expenses. In this case, this individual has insurances, could be errors and omission insurance, liability insurance, has some type of supplies, and maybe they have a license that they have to purchase through the jurisdiction they live in. So that's all he has. He's the locksmith. And then another thing we see a lot of is the vehicle expense used in the business. We'll open that up. And this is what you want to make your entries for. You want to describe the type of vehicle, when the vehicle was placed into service. And then down here, you're going to come to these three tabs. You're going to see business miles, commuting, and other. These would be the miles where if you remember that dollar amount or that cents, for example, the first 6 months, it's 58.5 cents a mile deduction. In the last 6 months, it's 62.5. Commuting means you're going from your house, your residence, to a place of work, whether it's a wage earner, W-2, or self-employment. And let's put down 0 because he doesn't commute. It's all business miles for him. And other expenses or other miles would be maybe going to the laundromat, church, grocery store, theater, stuff like that. Down here, it's going to ask you a bunch of questions and you're simply going to check. And I tell people that everybody has some type of evidence regarding the use of their vehicle. They've got a DMV bill, they've got gas receipts, they've got insurance receipts, and whether it is written on a piece of paper or if it's written in a computer, they do have evidence. So you're going to be checking that. And again, you want to ask these questions pertaining to the use of the vehicle for business purposes. All right, we're going to do that. And that's it for the Schedule C. It's pretty basic. We don't do depreciation. If someone says, I got an asset, I'm depreciating it, you say, we don't do that in VITA. That's outside of the scope, not in scope.
Hey, Jerry, I just have one comment. Usually when we do the Schedule Cs, usually it starts with a 1099 NEC. I mean, most of our self-employments usually come in. So I usually fill out that first because there's a spot to fill it out on the form.
Sure.
And then it says, do you want to schedule, attach or create a Schedule C? And you say yes. When you do it that way, it seems to be a lot less error because some of the stuff already kind of flows through it.
You can do it that way, but not everybody is going to have a 1099.
Oh, I agree. I agree. Not all of them, but I would say 90% of them.
You know, in my line of work, it's probably about 30%. So yeah, just depends.
In your VITA work or your
VITA work and my self-employment. But let's not discount that. Let's go ahead and describe the 1099 NEC. So you go to the income section, you come over here, and you can start with a 1099 NEC. That's non-employee compensation. You know what we can do, John, in our third adventure in a couple of weeks, we can go ahead and describe that. This is an information return, and you want to keep in mind information returns are issued to taxpayers, and sometimes taxpayers, they're not going to get one. So but yeah, we can run through that. We'll do that. I'll make a note for the third time. Okay, let's go to capital gains. The capital gains, this is something that some people get really intimidated about. All you got to remember is if you have a capital asset and you typically have sold it, the term is called dispose, which means you relinquish title to the capital asset. And so in this particular case, we open up the capital gains screen. We're going to indicate that both of these individuals have shares in a corporation, they're shareholders, and they bought it on a certain date in 2020. They sold it in a certain date in tax year 2022. And then we're going to indicate the sales price. And this is what you're going to see most of the time. You're going to see a 1099-B with the basis reported to the IRS. And these are your choices. Sometimes it's not reported. And I've had not reported, so it begs the question. I asked the taxpayer, okay, what's the cost of your shares? And they go, well, I don't know. I said, well, this is your return. And so that means we're going to have to figure out what the cost is. And so in my VITA business, I would tell them, okay, if we have the time, let's go ahead and look it up. You can find that. In my business as a practitioner, I tell my client, I'll be happy to look it up for you at $200 an hour. And so usually they can figure it out because the internet's a wonderful thing. It's not perfect, but you can find the cost of shares in corporations going back about 100 years, and which would accommodate your taxpayers. Sometimes you have to pay a subscription to it, but in this case, it's reported. And so now we have the sales price has been indicated. The cost would be 7,000. So right now we know if they sell it for 7,000 and they bought it, let me restate that. They sold it for 5,000. It cost them 7,000. We know that's a loss of 2,000. And we do know from the dates here, this is a long-term capital loss. Okay. And so that's as simple as that. That's usually all you put into the software there for a capital gain. So we're going to hit continue. If you have additional transactions, you come up here. In the VITA program, if you have someone with 100 transactions, what I am going to direct folks to do, unless I'm vetoed, I'm going to have them aggregate gains and losses, because we cannot have someone entering data for 3 hours for someone who's got all these different transactions. So but typically you have a few transactions. All right, then we're going to go to itemized deductions. We're going to show you a couple things here. This is for your mortgage interest. You're going to see a lot of this in the VITA program. And we're going to go to that 1098 that a lot of people are going to get. And this is that return that shows a number of things to include interest and dividends. Let me restate that: interest and points paid by the taxpayer. All right, we open that up, open this up, and we see the name of the lender, interest paid by the taxpayer to the lender for the loan, and then points paid. And we know about the general rule. The general rule is you have to amortize it. The exception is you can deduct it all in 1 year. So that's going to be the choice of the taxpayer. Hit continue. And we're done with that as far as interest and points. And then down here, this is going to be real estate taxes. You'll find that on the property tax bill. And it says non-business property. This means their personal residence, which is deducted on a Schedule A. And then I think that's all we need to attend to there. Let's go to taxes paid. And we're going to open this up. And in this case, we've got down here, real estate taxes paid of $1,800. And then we've got property tax, and this is something that you'll find on that property tax bill of $500. Okay, we'll hit continue. And hit continue. Now what I'm going to do, I'm going to make a on-the-fly change here. I've entered information for federal tax payments, quarterly payments, and we're going to go ahead and show you how to delete the entire entry. And then if you did have estimated tax payments that you're making to the federal government and also to the state government, you'd simply open up the tab. You would ask them about their quarterly payments and you would plug it in here. And if you have a state of California, quarterly payments, you'd open up that tab and you would plug it in here. And you want to indicate, of course, state of California. All right, so that's it as far as that item. And so let's go to our, now we're in 2022, so we don't have to worry about the recovery rebate credit, even though in this particular software right now today, and let me see if I can show you, it was there yesterday, it's probably here today. Yeah, this does not apply in tax year 2022. So this tab will eventually, should go away for the real TaxSlayer Pro program. All right, we're going to come down here to health insurance. And if you remember, we had the taxpayer wife, her employer paid her health insurance premiums for her and her husband. And so they're not in covered California. If they're in covered California, they'll be issued this IRS form along with a couple of state forms. But in this case, they're not. We will show you in either session 3 or session 4 where they are in covered California, and then we'll calculate the amount of the premium tax credit. Right now, this is a work in progress and no states have been added. And then this is our tax return. And let's go through this. We got a couple minutes. You can see when you have a draft form, the IRS puts the term "do not file." And so this means this is a work in progress. And you can see the income is reported on line 1. That's that wage, W-2 wages. You can see the amount of the capital loss, which is $2,000. They're allowed to deduct that in full in this particular year. And then you can see all the way down here. And again, this is a little garbled. That's why it's a work in progress. But you can see at the end of the day, you have the total amount of taxable income in this case, which is down here, 38,000 and change. What will happen, the software folks, is they do fixes, they do add things to it. Again, this is a work in progress. If it's still this garbled for the next time we meet, we'll just revert back to the 2021. All right, yeah, you can see it's a little garbled, which means it's not lined up. Total tax should be that 3998, but you can kind of see the idea of how this is going to be populated. All right. Okay, I think that's all I want to go through now. And so let's open it up to any questions that you may have. And John, wait a second. Let me go ahead and go to our last screen. Let me see if I can show everybody our last screen here so they can make a mental or a written note. All right, John, can you see that last screen?
Yes, I was on mute.
All right, so so the next session we're going to meet on December 3rd. What we'll do, we'll go through John's 1099 NEC recommendation, and then we'll really spend a lot of time with the credits, and there'll be more time spent in the software, well over 50% of the time, because now we need to transition really playing with the software. And then what I'll try to do in advance, I'll try to publish a fact pattern for taxpayers. That way you can go ahead and tackle it in advance of our session. And then if you're interested in attending a VITA 1 class, there's one at Coastline in January, where we have the students go through the basic, the advanced, and the military certification. It is a college class, so you got to pay the $46 for the credit hour, but there's no cost to books. And so if you want to do that, that's something that's available in January. And then that would prepare you or reinforce some of your knowledge, and then you can come back to St. Killian's and you can divide and conquer. If you decide to go ahead and volunteer at other sites with this particular class, you'll be certified up to the military level. Okay, now we'll open it up to questions, John.
There's a process question from Jennifer. She wanted to know how, and Jennifer, I think you're talking about St. Killian site, because every site could run differently. About we're going to prepare the returns in person. We do tend to have filing in person on the Saturdays, and then some will be a drop off, and they'll pick up the following week. So it's a hybrid.
Yeah, that's correct. It's a hybrid. So what happens is our clients will come in, we'll ask them, do you want to get your return done today, face-to-face? And if they go yes, then they'll do the face-to-face thing. If they go, no, I want to drop stuff off and come back next week. And then that's when we have our remote preparers do it remote. And then what happens is the taxpayer, at that point, they have to fill out the intake sheet, and they have to provide copies of their documents, and then they leave. And then what we do is we prepare the return with our remote crew. Taxpayer comes back the next week, and then they pick up they actually sign the 8879, which is the e-file authorization, and then they pick up a courtesy copy of their return. All right, any other questions?
Jerry, I have a brief question. Can you tell me?
Yes.
Can you tell me when 2022 Schedule X's or standard deductions for the Federal Tax Board, California Tax Board are available, and how you find them?
You mentioned the standard deduction amounts.
Yeah, standard deduction amounts in Schedule X.
Yeah, the Schedule X would be your California amended return. And so if you want that information, probably the best thing you can do is go to the Franchise Tax Board website. Sometimes you're trying to find a document and they tell you it's not available. And so what you do, you email them, and they're pretty good about it. They'll email you the document back usually within an hour.
Oh, great. I'll try that. Thank you.
Sure.
Jerry, I have a question on the standard deduction for the state of California. I was on the FTB website yesterday, and I do not see what the standard deduction for both single and married filing jointly are for 2022. They do have 2021 listed there, and I want to know, do you know if it's changed?
The short answer is it will change. It's adjusted every year. What I can do, I think that was from Barbara. I can
Yeah.
reach out to the Franchise Tax Board, and we can get that information and then throw it on a PowerPoint screen so we can take a look at it in a couple weeks.
That would be great, because many of our taxpayers don't qualify to itemize for the federal, but they do for the state.
Okay.
So, yeah, so
Now
I'm
you want
looking for
you want
those numbers.
standard deduction, Barbara? for the
Yes, they'll
state?
take a standard deduction for the federal and they'll itemize for the state. Some of our taxpayers may have management fees on their brokerage accounts and so forth and so on. Even though their income is lower, their management fees are pretty high. And that's a deduction for the state, not for the federal.
Okay.
Yeah, and they
Yeah, we'll
increased
talk
the
about-
standard deduction for the federal a number of years ago, and California didn't conform. So yeah, there's a lot of them that have that itemized for California, but not for.
Oh, yeah,
Oh,
we
Federal.
have quite a bit, and
Yeah.
that's what, yeah, and we do that training with our taxpayers, because
Yeah.
all they see is the massive federal standard deduction. Oh, I don't have that. Well, yeah, but you might have it with the state.
Oh, yeah,
Yeah.
we'll definitely talk about that. And then regarding the nonconformity, the Franchise Tax Board Publication 1001 talks about nonconformity and partial conformity. And so that's a helpful document. And we'll talk about that in future sessions when we go through the California return, California adjustments, and the California itemized adjustments.
Thank you.
Okay, thank you. All
Jerry,
right,
can I
let's-
ask a question?
Sure.
This is Yana. On the self or principal residence, isn't there a provision for widows and widowers that they have 2 years after passing of their spouses to take advantage of the higher deduction? The $500 million instead of the 250,000?
There are some certain rules. What I can do, since I don't have it all on my brain housing group right now, I can have a very short review of sale of a resident when you have a situation where someone has passed away.
Yeah, okay.
Okay.
And
Sure,
Jerry,
thank you.
this is Barbara, in that presentation, will you discuss stepping up?
Step up in basis.
Yes.
Yes. In fact, I think we talked about that last year, but we can throw in a couple of examples and talk about the concept of step up in basis. Sure.
Right.
Sure.
Yeah, because that's real important to the seniors who have lived in the house for 35 years.
Sure. Sure.
Okay, thank you.
Got it. All right.
Jerry,
Anything else?
I found something on the standard deduction for California. I put it in the chat. I haven't audited it, but that has some information there.
Okay, it looks like I see a URL. Is that what you're referring to?
Yeah,
All right, and then we'll
Post it
review
to
that the next
or
time
everyone
we
can.
meet.
Yeah,
And
or
keep
everyone
in
can look
mind,
at
if you're brand new to VITA, these standard deduction amounts, they will be populated automatically on the return, both the federal and the state return. All right. Okay. Anything else? We're almost at the bewitching hour. I've got 12:58.
This is Bruce. I just have one question in regard to the businesses. If they have a loss, I thought the general rule was that was out of scope for us, but I also know it's problematic for people to come in and really know whether they have a loss because there's so many things like the depreciation, they may not factor into it. But as far as you're concerned, if a business has a loss, it's not a problem for us to do their returns?
Well, as they used to say in the old Soviet Union, the party line is, what we don't do is we do not attend to taxpayers who have a net loss on their Schedule C. That's out of scope.
Or
What I will do
depreciation,
is,
yeah.
what's that?
Or depreciation. You mentioned depreciation, right? I don't think. Yeah.
Depreciation. Depreciation is a dirty word in the VITA program. We don't calculate it. We just don't. It's out of scope. But yeah, what I'll do is I'll reach out to our IRS representative, and we do recognize that some taxpayers do have a very small loss, and so sometimes there's an exception to policy, but generally we don't do it.
Yeah, I agree with that. Yeah.
All right. Anything else? I think we have time for one more question.
Could I ask if you take a recommend or an RMD for an IRA at the end of the year, are you supposed to pay estimated taxes throughout the year for that amount if you don't take it till the end of the year when you have to?
I think the way to answer that when you're talking about estimated tax, if you
Yes.
have a large amount of income at the end of the year, then you're gonna pay the estimated tax based on the amount that you expect to receive, and so it would go into the calculation. But yeah, you should be okay if you make that estimated tax payment, even though you got the one chunk of income toward the end of the year, but you got to estimate the amount.
The fourth estimated tax payment is due January 15th, so that covers that.
That's right. That's right. You get into the software, it's going to give you that last date, and you're going to plug in whatever your estimated tax is determined to be.
So you do your RMD in late December. Well,
Yeah.
it's recommended you start it sooner than that to make sure it goes through. But then you take your 1040 ES on January 15th.
Okay, so you
correct.
don't have to spread it out over the year.
No, it's supposed
No,
to be in the quarter
no.
you incur the expense.
Yeah, because what happens is your software is going to look at your estimated payments. Let me restate that your estimated income, and if all of your income is in December, then you're not going to be penalized because you didn't make an estimated payment in April or March, something like that.
Mm.
The other thing is you can have a sizable amount deducted from your RMD for taxes.
Yeah, there's all sorts of ways you can
withholding,
You
yeah.
can
Mhm.
yeah, all
Withholding,
sorts of
yeah.
ways you can do it.
Yeah.
All right.
Okay.
Putting it
Okay, well, I
down
think we're going to
market.
wrap it up. So I want to thank everybody for participating. John, thank you for being the co-host.
All right.
And please join us in a couple weeks, and we'll talk about the various credits in depth.
Thanks, Jerry. Thanks,
Yeah,
John.
sure.
Thank
Okay,
you.
take care,
Bye.
everybody.